The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody.
Hello, traders.
Welcome to Saturday webinar. So we did this about 5 weeks ago, and it was a pretty good success, and the time went really quickly. So we did the same thing. We tried to put a lot of content here together for this webinar, and most of it is recent content in the last few days. So we've got a lot to get through. I think I put some more content in here than I did last time, so hopefully we can get through it quickly and still have an hour on the back end for some question and answer, which most people like. Again, for the people who have used this before, there's a toolbar over there on GoToMeeting, and you can submit a question if you'd like. If we're moving along and I see the question is relevant to the topic we're on, I'll try and hit it. If I'm not able to touch on it, it's because we've got to move on quickly to get through all the content. And if you want, you can save that question for the question and answer session, and we'd be happy to go back and look at the chart and kind of revisit anything that you had a question on. So let's kind of get started here. All right, there's my little red pointer. Just a quick summary of what we did in Day Trading 101. It was a basic seminar, real basic stuff. A lot of people probably already were familiar with it, but a couple of books we pointed out that I think are really good for people to pick up if they haven't already is Reminiscence of a Stock Operator. That's a great timeless book of Jesse Livermore, one of the great traders in the past when trading was different, but still the same because of technology and because of psychology and crowd behavior. It's all the same, no matter what year you're in. Japanese candlestick charting, another great one to get your feet wet and understanding candlesticks. And A Beginner's Guide to Online Trading is a pretty good one as well. Kind of a simple, comprehensive, informative book on different aspects of trading. And then for this seminar, webinar, we really recommend trading in the zone. If people are trading their own money, you're probably well aware of how much emotions and psychology can come into play and how much of a facet it really is in this business. So Trading in the Zone is a great book for the next level reader. I highly recommend it if you don't already have it. And another thing we touched on, which is really important last time, was direct access trading, which essentially looks at an online trader like us here, D for direct access, plugging directly into the market, no middleman, where online traders like Ameritrade, E-Trade, things like that, you have a middleman or a broker. You're the trader, and you still have to go through basically one step before your price and your executions get to the market. So that's just the real difference between direct access trading and online trading. And so those were just a couple of rehashed topics from the past. So what we thought we might do here is kind of walk you through the day of how we start each day, what's going on each morning as we prepare for the day, because chance does favor the prepared mind, and if you just sit down at 9:30 Eastern to start banging away, you're probably missing a lot of the picture that was there earlier as far as getting prepared for the day. So what we do is we use a service called Briefing.com, and in Briefing, Andy, your microphone's like hissing. That's weird. I'm not sure why. Okay. Yeah, just leave it on mute, I guess, unless you want to chime in. Briefing.com is a web-based service. It's real simple. It's like $39 a month, and we use it a lot pre-market. And here's one of the pages we use. This is just a running image here of what's going on throughout the day. So we get timestamps, and we get news stories coming in. And pre-market, we'll be looking through a lot of these news stories to try and find out some of the bigger stories of the day. And again, this is aftermarket. So here's a story on this AUY, which we'll trade sometimes. And so if I look through the news and I see something we trade pre-market, I'll go ahead and maybe take a quick look and see that I know the AUY here just had some earnings reports, and these are the details of the earnings. So that's kind of a quick rehash on that. Here is another important page that we use on Briefing. This is called the economic calendar, and each day there's possibly 2 or 3 times throughout the market trading day that you want to be aware of. If you've ever been trading and the market does an about face or a quick reversal, only to find out that some bit of news or economic data came out that you weren't aware of, it's really important to try and stay on top of that. So here's how we stay on top of those. Would be, let's take an example of March 4th, at 10 a.m., which is essentially a half an hour after the market opens. We've got service managers, and here's what the actual numbers were versus what the forecast was. And so essentially we just remind ourselves, hey, half an hour after the bell, we've got some information coming out from ISM, and then an hour after the bell on this day we have crude inventory. So if we're trading airlines or crude oil stocks or drillers or anything having to do with energy, you better be aware of crude oil inventories coming out at 10:30 Eastern on every Wednesday is pretty much when they come out. And then we also had the Fed Beige Book on March 4th here. That was another, it came out at 2 o'clock Eastern. And essentially that gives you an idea of what the Fed is thinking at any given time, what their comments are behind closed doors. It kind of gives you an idea of the data that they're looking at as well. So here's an example of 3 pretty important market timing events that you've got to be aware of. So we use briefing.com each day to make sure that we have no surprises coming up in the economic calendar. And another thing we'll do with briefing.com in the morning is, like I said earlier, we look for earnings, earnings up, earnings down, surprises, negative surprises, and we can find those here on briefing with a real quick example. Normally there's a lot of earnings on this page, but this was an easy day to show because there's just a couple of earnings. This H&R Block, had earnings. They were looking for 10 cents, but they actually had 20. And so maybe that's a stock that I'll have in the back of my mind that particular day that, keep an eye on it because it had a pretty good earnings surprise. Why is that important? It's important because earnings surprises totally change the fundamentals of any valuation model of the funds and the institutions following this. And so if you have a significant change in the fundamental business model of a stock, you're going to have a pretty good opportunity at catching an inefficiency and a rebalancing or just kind of a return to the mean. And so those earnings play stocks can be something to keep an eye on. In this case, we had a negative surprise. Ann Taylor, that's a stock we've traded before on the retail side. Now, Ann Taylor was expected to do negative 55, but they did twice as bad. They lost $1.03 per share. And that was a negative surprise of 48 cents. So here's one I might scribble down on my notepad. Hey, watch this in case of weakness in the retailers today. Or if this thing continues to go to lows, maybe it wasn't priced accordingly when it opened up, so there might be some more run to the downside. So there's an example of how we use a briefing as to try and hone in on what's going on each day. Let me just say before I go to, did you have something you want to chime in there, Andy? Hello, Andy? Many days there will be a stock in the news. For example, yesterday, Wells Fargo. We woke up in the morning and a lot of talk and chatter on Wells Fargo. And so when you start to hear people talking about GE, the stock of the day, or Wells Fargo, the stock of the day, pay attention because there's any time the street or everybody is collectively focused on one stock, I like to pay attention to that stock for leadership. On Wednesday and Thursday it was kind of GE because GE was having some real negative news. And then on Friday, Wells Fargo came out in the morning and they had some positive comments. So stock of the day is what I call it. Just trying to look to that stock, whatever it may be, for leadership. And we'll talk about more how to find those. Are you with us, Andy? I hear you.
Can you hear me?
I can hear you now.
Okay.
Let me see here. Yeah, your mute is on. Yeah, you're muted. Your microphone's unmuted. A lot of times,
can hear me now?
I can hear you. You're good.
Okay. Okay.
So a lot of times, pre-market, another thing that we're looking for is Andy will have on his screen what you're looking at here. This is our trade ideas alerts. We've used these alerts for many different scenarios, but one of the scenarios I wanted to point out here was pre-market. You can program trade ideas to only look for stocks that are active pre-market and post-market. So in this case, these stocks are active in the post-market. You can see those are all post-market. And what that's doing is, let's just assume that these were saying pre, and it's pre-market. We're looking through stocks that are continually coming through as active pre-market, and that's another way to kind of give us an idea of, what stocks are active and trading more than usual pre-market. And so it gives us an idea when the bell rings that, oh yeah, I saw that thing coming through about 5 or 6 times on my morning alerts. So again, here's just another way to kind of give us an idea of what stocks are in play, so to speak, for lack of a better description. And of course, Andy, as usual, if I'm missing anything or leaving anything out, feel free to jump in.
Oh, sure.
So kind of back to still preparing for the day here. We've looked at briefing.com, got an idea of what stocks are in the news, what stocks are having earnings, what stocks are having warnings. Now the difference between earnings and warnings is usually about 3 weeks, 4 weeks before earnings come out, a company is really obliged to give any negative downside warnings of them falling short. If they come in and fall significantly short without giving a warning, then it raises the eye of the SEC. So a lot of times we want to pay attention to a company coming out saying our revenues are going to be lower than forecast, or on the upside, an earnings surprise, our revenues are going to be higher than forecast. So to us, that's significant because it's the actual company making a statement. How is that different than an opinion or an upgrade or a downgrade? Well, upgrades and downgrades don't carry as much weight, really, because they're basically opinions from people outside. And many times those opinions, in my opinion, can be, they can have ulterior motives built into them, and they're not great opinions. So sometimes you'll see a stock trade down 80% before an analyst comes out and gives it a sell signal. So that's kind of crazy to wait that long before these analysts come out. So we try and disregard the analyst opinions. We try and pay close attention to fundamental changes in the company's business numbers or any opinions that the people themselves in the company, by ways of earnings, guidance, lower or earning surprises would be. Yeah, Greg, that Trade Ideas is programmed into Trade Ideas alerts. There's a way to do that.
Pre-configured strategies.
Yeah, go to pre-configured strategies, and it'll be in there for you, all set up, pretty simple. So yeah, we talked about earnings, we talked about warnings from the companies, we talked about stock of the day. I got ahead of myself there, but like I said on Thursday and Wednesday, the stock of the day was GE, simply because that's what the big news was overnight. And on Friday, the stock was Wells Fargo. They had made some positive comments, so we were watching that throughout the day. You know, always keeping an eye on what's the stock of the day doing. And the stock of the day always changes. Some days there might not be a stock of the day, but you should have a pretty good idea of what it is that the market's focusing on. And then, you know, CNBC, a lot of people don't really care for it, but it's kind of a necessary evil. We have to listen to it because that's what everybody else is listening to. Would I like to listen to Bloomberg? Yeah, they have a lot more interesting information on there, and less, you know, people screaming at each other on 10 different boxes at a time. But the fact of the matter is, you go to any trading office in the country, and they're watching CNBC. And so we have to watch what they're watching. And one of the best periods in the morning is about, I think it's about 10 minutes to 9, so 8:50 Eastern time. You get Art Cashin. He's a grizzled veteran. He's been on the floor forever. And he comes out on the camera, and they ask him what his opinion of the day is. And I always make an attempt to listen to what Art's opinion of the day is, because he's a pretty smart guy and he's seen it all. So, you know, there's kind of a good snapshot at the 30 minutes at the most, maybe, that we're spending before they open each day, and what we're doing and what we're focusing on.
Yeah, I would like to add to that economic calendar, and you really want to look at that each day and know what's coming out and at what time, because stocks can get really volatile on those a lot of those numbers, even if it's not in that sector. So even if you may have oil inventory numbers coming out, it can affect any stock that you're in. So what I always try to do is be careful how much size I'm in. I actually, a lot of times, will just try to get flat, you know, and have no positions around those numbers, because I know the volatility can get kind of crazy. So always notice, you know, especially, you know, things around Fed Beige Book. There's some big ones, and you'll get to learn them. But yeah, be careful how much size you're in. And a lot of times, like I said, I would just like to sit back and be flat during those times.
Some other big ones will be existing home sales, new home sales, since the market is really keyed in on home sales, how much inventory is moving, how much inventory is building up. So that's been a big market mover as of late too, the home sales. Okay, so once the bell rings, we kind of go into you know, the opening session mode. The first 15 minutes are really, really crucial. And people who are on our live service have heard us say many times, there's a lot of money to be lost in the first 15 minutes, and there's some money to be made as well. And chances are, some people have made some pretty good trades in the first 15 minutes, but more often than not, that period of day has a very volatile tone to it. The candles are very wide. The stock ranges in every 5-minute candle are very wide, back and forth, very volatile. So you have to be really careful that time of day. And so over the years, we've kind of just learned to really avoid jumping into things really quickly because more often than not, it's put us kind of behind the curve rather than giving us some good trades to work from. And that's just coming from experience. So first 15 minutes, the bell rings. Focused and relaxed. One of the mistakes we made early on in trading back 9, 10 years ago was just, like I said, jumping in right off the bat, trying to chase everything I saw, like a dog chasing his tail. But you got to remind yourself it's a long day. It's 6.5 hours. There really is no hurry. And in the long run, you're going to be better off just letting the smoke settle, letting things settle in and see where opportunities start to show themselves. Because, again, it's a long day and there's going to be a lot of opportunity. To start chasing your tail in the first 15 minutes has not been very productive in our experience. And again, I can actually say there was a trade this week that we got in trouble with right off the bat. It was Humana. I know Andy's agreeing with us. In the very first minute, basically what happened is it looked like a good setup, but it was probably 10 or 12 minutes into the 15 minutes into the open, and Humana was putting in just violent up and down ranges where maybe the normal range for that stock, during the day might be something like this. And what happened was he got too much size. He didn't realize it, but he got in probably twice the amount of size he should have gotten in, and basically got caught up in these morning ranges. And so that was a tough trade, and it was a big loser, and it took a while to overcome that.
Sure.
Actually, the whole day never really recovered.
No, that was a bad day, and it's really tough. I have to remind myself. It's like we did the same thing on yesterday. We both, we knew the conditions extremely oversold at these levels, and we had the first bar of the day was a nice green bar on good volume, and it's really hard to not to want to chase, especially when you're feeling like there's a huge bounce coming in the market. But I can tell you guys, I'm usually pretty good about sitting back and watching, but like lately I've been my demons have been kind of taking over, and I've been getting in trouble. And yesterday it was the same way. I had to dig myself out of a hole. Luckily I ended up having a good day, but I got myself in the hole, and more times than not, I find that if I trade the first 15 minutes, I'm down on my blotter. So there's so much you can learn just by sitting back and watching, and sometimes maybe even 15 or 30 minutes. There's some good setups that happen at the top of the hour. So,
well, yeah, I'll tell you what. There's been a lot of setups at the top of the hour lately,
yes.
And I wish we'd been more attuned to it when it was happening. But in hindsight, of course, it's easy. But looking back, the last couple of weeks, half an hour after the bell, the market had to absorb a lot of sellers that would come in. It seems like the financials seem to get hit at 10 o'clock Eastern a lot lately. So whatever positions you were in and setting up for in the first 15 minutes could easily change at the top of the hour. So I'm not saying this is something we do every day, but lately, the way the market's been, I've been really paying attention to the top of the hour. There's been some reversals, and it's kind of typical for a bear market, guys, for the sellers to sit there and wait for the people to kind of come in and look around and feel like it's safe, and get the buyers to start to build on each other's confidence. And before you know it, they're starting to come in with bids, and that's when the sellers come out of the shadows and start hammering because they know there's some liquidity there and some people they can pound on to unload stock. So that's been happening a lot lately, and we're paying attention to it for sure. Quick question, Greg. Scott, I'm sorry, I'll hit this question. Do you think earnings can be detected beforehand, i.e. volume spikes prior to release? I think, Scott, earnings can be a classic buy the rumor, sell the news. You see a stock like, say like McDonald's, for example. Maybe it's been having a nice month, just moving up, trending, just a beautiful trend. All of a sudden it has earnings. The earnings are great, but why the hell is this thing gapping down 2 points the next day? Well, it's a classic example of getting ahead of the herd mentality. The money in the stock knew it was probably going to have good earnings. So to answer your question, a lot of times if you see a stock that's been trading very well going into earnings, Scott, chances are the people who are close to that company might know that good earnings are coming. And if you're scratching your head as to why did it gap down after good earnings, It's just kind of a classic buy the rumor, sell the news. The market is really always one step ahead of itself. So that's...
Yeah, it's very important when you're looking at these earnings and warnings and news. Anything you're looking at, just know that they're there, and there's news out here. Don't try to form opinions on what the stock should do off those earnings, and you want to let the price action dictate that. It's very extremely important. I can't tell you how many traders I've seen over the years. They, oh man, look at this, they had great earnings, man. I'm just looking to buy this, right off the get-go, and next thing you know, the stock is just selling down all day.
Here's another thing. If say our stock maybe misses or slightly on, but gaps down big the next day, some people think, oh, this is a great opportunity to jump in. Here's kind of a rule that Andy and I have. After a stock is beat down like that on earnings, on fundamental news, not an opinion, but fundamental news, we usually wait at least more like 3 days, because it takes a good 1, 2, maybe 3 days for the sellers that were in that to reconcile that this thing is not going to bounce and everybody wants out. And so we have to kind of flush the sellers out first before I would look at a stock rebounding on a daily chart after a big gap down from bad earnings. So I haven't seen much of that too much lately, but it is something that happens. So back to the first 15 minutes here. We're observing how things are shaping up, what's strong from the open, what's gapping up, what's not holding their gap ups, just a lot of observation, using our alerts, seeing what stocks are coming through, big stocks like Goldman Sachs, Citigroup, Cisco, any of the big name companies that make up the anchor of a lot of these sectors. We're paying attention to how they're trading on the open. And then taking it a step further, looking at ETFs, which I'll show you how we do that in a second, and seeing the percentage change. A lot of times people focus on the percentage change. Well, this thing's up 5% from yesterday. Well, that's great, but as a day trader, if something gapped up 5% and just going sideways, it's not really going to benefit me. What I really want to know is what opened up down 2%, but has run up 2% in the last 5 minutes since the bell rang. That's showing me where the money is today. And so those are the kind of things I want to focus on. What does the percentage change from today look like? And we organize the ETFs accordingly. And I look at those maybe 3 or 4 times in the first 15 minutes to get an idea. It's kind of like a horse race, seeing which ones are jumping up to the top. If I see the home builders running up and then pulling back, maybe that was a head fake. But if I see this SLX, the steel index ETF, running up and then continuing to hold a bid and moving higher, well, then maybe there's something to that steel index I want to take a look at, because it's not pulling back. It's run up from the open and it's staying there with some pretty good support. And how we do that is a board view. It's just a simple board view. This is from Andy's. And, quickly, BBH is biotech. Airline index, XAL. USO is our oil ETF. PPH is pharmaceuticals. This is gasoline. It's not to be traded, but it's just kind of a benchmark as to how gasoline is doing. This is a great ETF, gold. We made a pretty good chunk of money in gold yesterday. XLE, energy. So I will see how these things are sorting on the open in the first 15 minutes. And I'll also take a look at what's weak. If we want to go short, well, regional banks are down 0.6 from the open. I'm sorry, or actually I'm going over here, aren't I, Andy?
Right.
Okay, so down 5% from the open. So basically these things have run 5% down since the opening bell, and the biotechs have run up 5% from the opening bell. So in the first 15 minutes of each trading day, I'm really paying a lot of close attention to this, trying to zero in from a top-down perspective, trying to focus on the sector first, and then we'll focus inside that sector, or maybe just play the ETF, as we'll talk about as well. Been doing a lot more of that lately, and we will touch on that as well. Anything else on this board view before I...
No, you covered that very well.
Okay, so as far as understanding sectors and leadership and stocks and sympathy plays, this is something we do a lot of, and it kind of dovetails with what I just said about looking at that board view, trying to look at a top-down approach on how to approach the trading day. So everybody who doesn't have one, I will send out, of course, the PDF file that we used for the last webinar, but it really hasn't changed a whole lot in terms of the sector list that I use. The sector list that I send out to people, it really is only about maybe 25-30% of what's out there. It's very important for traders to get as familiar as possible with who the players are and how they relate to the other players, first tier versus second tier, and what sector they're in. Because if you don't know the players, it's going to be a hard time following the game. And once you know those players, it's like I said, it's important to find out who are the market leaders. Like, let's give me an example here in a sector. Have a good example,
Well,
Andy.
a good example of that was if we go back and look at that the biotech on yesterday. Genentech, DNA had a huge run. Yeah, and there were some stragglers. I was able to catch a few stragglers that ran with it, but DNA had about I can't remember. It was just a huge move there, but that would have been the leader.
Yeah, Genzyme was a stock that was a second-tier stock that we just knew from experience. And so we start looking up, when you see DNA coming through, alerts with high explosive volume, first we want to find out what was the news. Well, there was news on DNA with a merger with another company. But we start to see, well, how does that affect some of the other companies? Because that's really how it works. Sometimes other companies will get a sympathy lift from big news of a major player in the biotech. Major player was DNA for sure. Oops. Do you want to keep your ink annotations? I don't want to.
Just hit discard.
Ah, dang it! I knew that was going to happen.
No.
Okay, there we go.
There we go.
Okay, so where were we? Trying to get to know the major players in each sector. That was our first thought here.
And guys, that just a lot of this just takes time. I mean, when I remember when I first started trading, we traded two stocks for like 2 months, Comms and AMAT, and you're just focused on that. And but as you move along, yeah, you want to start getting a grasp of the 4 or 5 major players in each sector, and it does, before you know it, it's going to be over hat, and you'll just rattle them off as soon as you've seen that sector going to highs. You can just go through. You can find which one's the strongest, and it just takes a little time. Did I lose you, Steve?
I'm here. I'm sorry.
Oh,
I was on mute.
No problem.
Once you've identified some leaders in a sector, you want to find out, do the other stocks tend to follow stocks in this sector? Like, for example, in the shipping sector, there's a crazy stock that used to be a lot more fun to play, but lately it's been tough. Dry ships. They were kind of the default leader in the dry shippers, and there's about 5 or 6 stocks that we play off of that. In the solar sector, there's a major stock that pretty much is the leader. It's called First Solar. And so we're always looking, like when we see solar is getting interesting and running, FSLR, first thing I want to do is look at FSLR. To me, that's the leader of that particular sector, and I want to know how's that one performing.
Sure.
So there is that. And then, you want to try and get an idea over the years. We've seen, well, that particular stock never follows the leader, so I'm going to stay away from that one. Point being is you start to get an idea of which ones are valid sympathy plays and which ones just don't have enough volume. A lot of them you'll look up, you'll pull up, and it's done 70,000 shares for the day. You got to just let those go. Those aren't tradable, viable stocks to follow. And so if we don't want to just try and figure out a particular stock within that sector to play, the ETFs are getting so popular. There's more and more ETFs to play than we had even a year ago. I mean, probably twice as many. And, we'll get to the doubles and the triples later. But, the ETFs, if you're looking at home builders, like for home builders, I put Lennar. That's a pretty good that's a pretty good leader in the home builder stock. And if I can't get a real feel about, anything I want to play, some of the other home builders, Lennar, Toll Brothers, DHI, Centex, Ryland Homes, I just might say, you know what, screw it. Let's just go for the XHB. This is a viable trading vehicle. There is enough volume in the XHB. It does a couple million shares a day, I believe. And to answer your question, Greg, the minimum shares to follow, I think, should at least be 500,000 shares for a new trader. We try and stay around 350 if you calculate the total shares traded per day. I'm not comfortable trading stocks that do under 300,000 shares a day. It's a whole different animal, and for newer traders, especially in this market, and for newer traders, the more volume, the better. At minimum 500,000. If it could do 1 million shares, better, even better. But you want to learn on the ones that are liquid and not nasty. Financials, well, that's a loaded question. We have a pretty much a new leader in the financials. I think it's probably Goldman Sachs. Would you agree, Andy?
Yeah.
Because the banks are done. The banks are just done. That's a whole other topic. It's sad to say, but Goldman, I think, is going to be our new leader. So whenever we see Goldman Sachs coming through those alerts, Goldman, lows, 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 or on the flip side, highs, 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 I'm paying attention because this is a big stock now, and this is a bellwether stock that the market's going to really be paying attention to, especially as far as the financials go. So always paying attention to what Goldman's doing. And if Goldman's having a really nice run, hey, maybe if you don't want to chase Goldman, maybe it's time to buy some XLFs. So semiconductors, same thing. The leader in that space is going to be Intel. But you've got many, many more specialty stocks. If Intel's having a great day, you just don't want to chase it, and the other ones are starting to look like they're paying attention, just jump in the SMHs. That's a viable trading ETF as well. And the same goes through for Halliburton. Halliburton's going to be your number one oil service whenever I see OIHs, which is the...
or I would also put RIG in there.
RIG.
They're kind of a leader, too. Yeah.
Halliburton's kind of like the land-based, and RIG is sea-based. RIG is the ocean driller, and Halliburton is the land-based. So these two are the real bellwethers in the OIH index. And a lot of times, if we can't find a sympathy play in Weatherford or BHI or P10, we'll just say, you know what, let's just go for the OIHs. So the lesson here is ETFs are a viable way to trade as long as they have enough volume. You know, I'm hoping they would do at least 500,000 shares a day. Some ETFs don't have that, so you're forced to trade the stocks. But this is one of the things that we do look at in terms of sizing up sectors and leadership and sympathy plays.
Mm-hmm. Now, I would add to this, guys, typically you want to get the stock that's running in that sector. A lot of times it gets away from it. You don't want to chase, and it's hard to do. You try to look for pullbacks. Mm-hmm. In a case where if you see a stock in that sector that's coming through your alerts and doing really good volume, and you don't quite see, especially in this environment, I'm noticing I'm doing less and less sympathy plays just because it's been very hard to do. I'm trying to grab the leaders more, especially if I see them doing good volume. But instead of maybe looking for some sympathy plays, first I'll watch that leadership stock and see if I can get a decent pullback, a decent entry, and grab that one. You want to get the one that's performing the best, that's for sure.
Here's an example.
A lot of times they get away from it.
Here's an example of that graphically. Let's say we see this is Halliburton, so let's say this is Halliburton, and nothing else is running, and we don't want to buy the OIHs, but boy, there's a lot of volume down here in this Halliburton, and we really want to pay attention to this. And here's kind of how the chart looks. You pull it up, and let's assume these are green candles, not red candles, and right about here you're going, boy, I like that, but I know if I buy it here, I'm going to suffer a pullback. Where would be a good place for me to maybe bid this stock and try and catch a little better entry? Well, I would probably go back to the prior candle, maybe the high of that prior candle, kind of lines up with the low end of this, and if the stock's trading up here, you might just get lucky and catch a bid down here, and you're off to the races. But point being is we try not to chase, a couple of good green bars, if these were green, up here. And if you're not willing to play a sympathy player or grab the OIHs, size up the candles and look at it and say, well, I'd be willing to take a chance here, and then, give it, a little bit of tight pullback. But that's probably an example of
I think you'll see a good one in that alerts chart we have coming up.
Yeah,
here.
we have some charts coming up here, so we can start getting more specific here. Okay, so sympathy plays. We had a sympathy play on Tuesday or Wednesday, I think it was. I can't recall, and it seemed like a good example to call out. And I'll set it up for you. Here's what it was. It was using briefing.com, and the alerts. We saw P-O-T, potash, running to lows extremely, extremely quickly. Okay, here it is. And right about here, on this bar down, we noticed a news story came out that the Russians were going to start undercutting potash deliveries to Brazil, and Brazil was going to start paying 25% less for their potash. Well, knowing the agriculture industry, there's a couple of players in there: Mosaic, Monsanto, Potash, IPI, and there's also an ETF called MOO. But MOO is not really a viable trading candidate. It doesn't really do the amount of volume we'd like to see. So rather than chasing this pot to the downside, we started to assess our options. And one of the options was to look at a sympathy play called Mosaic, M-O-S, Mosaic. And what I did here, guys, is I tried to line up the time frame on these charts. You can kind of see everything kind of lines up here, and it's real close. So, this 9 o'clock hour here is right about the same as this 9 o'clock hour down here. And so the illustrated point I'm trying to show is on this candle down here, when we pretty much pulled up potash and said, well, something's going on here. This got a lot of volume coming in. We know what the news is. How can we get short this thing? Well, we didn't want to chase this one because it pretty much fell out of bed. But when we pulled up Mosaic, Mosaic was still kind of trading up around these levels, where at the same time, pot had just fallen out of bed a couple percent. So you did get a quick down move and a quick up move. Andy, I think you threw a short offer out right about in this area.
43.90.
43.90. Okay, so he didn't chase it down here, but you did get some volatile action here as Mosaic was trying to figure out what's going on over here in my sister company, Potash. And so it turned out to be a pretty good fill. And there was an example of using, if you can almost see it, if you look at the time, the way I've drawn it, we had about 30 seconds or 60 seconds to react there to how we wanted to play this particular trade. And so there's an example of looking at Mosaic. Didn't fall out of bed yet, threw an offer out there, got hit, and you can see the trade worked out to be a pretty good trade. I forgot where we got out of this one, but
I kind of scaled out because on the way down, but it ended up being a very nice trade. I held on. I can't remember the last couple of hundred I held on for a while, but the key is, guys, this is a prime example. When you, I saw pot, coming down through my alerts, moving down on fast, heavy volume, close to lows. And this is one where I knew there was something out there on pot, if not the whole wide industry at the time. In this case, yeah, I just went and without hesitation, I grabbed some Mosaic. We have another, I think, chart to show you too, where Apollo kind of did the same thing. But the key is, I was looking for volume. Mosaic hadn't broken like a great entry. It hadn't broken like pot has, and there was news driven, there was volume. This is a prime example when you probably want to use a sympathy play.
Yeah, because this one had already pretty much broken down or was at its support levels, whereas Mosaic was not. And then once you're in the trade, here's two things we're watching. Well, can it take out this prior levels of support that it took out here? And it did. So here's where the trade was really on, because two things. We took out the prior level of support, and as you can see, we did get a pretty good increase in volume there. That's about the average volume. Everything above that was extra volume. So two good confirmations there once we were in the trade, breaking down from a level of support from earlier, and volume, which obviously was in sympathy to the negative news that came out on Potash. So there's hopefully a pretty simple step-by-step how we were thinking process of a sympathy play. Tobias asked if we ever use the leverage, or do we like the leveraged ETFs? Yes, we do, and we're using them more.
We'll get into that.
We're using them more and more. I don't necessarily recommend them for beginning traders, and we'll talk about why. But yes, Tobias, without a doubt. All right, determining what is strong and what is weak. Well, how do we determine? A lot of people hear us say, "Oh, this is really strong. It's really holding up well today." Well, how do we know that? Well, let's look at another couple charts here. I'm going to put another chart here. I'll just put it in right now. And again, I've done the same thing. I've tried to line up the time frames as best I can here. 8 o'clock there, 8 o'clock here, to illustrate what the market was doing. Here was the spiders. So we were essentially focusing on the spiders putting in a wick up here, couldn't get through, falling down, basically came in and filled its gap and put in a nice little tail here. You guys know, maybe, or you don't know, but I love seeing wicks, mostly on a daily chart. If this was a daily chart, this wick would have more significance, but on a 5-minute chart, if I see a wick like that, that tells me there was not a lot of selling down here. There was a pretty good amount of buy support, and the price popped right back up very quickly and traded at this area. So I start to see wicks like this, and it makes me think short-term reversal. But all the while, we kept noticing, wow, look at this LRCX, semi-equipment maker. They are just bucking the trend big time. We've got the market going down, and we've got this LRCX going up. Well, we didn't do anything with it, but talk about a mental note. Very strong mental note to self. Even write it down if you have to. LRCX is very strong relative to the market. So we got market going down, LRCX going up with relative strength. So where's the play here? Well, here's the play. Right when I noticed this turn in the market, because we're trading the market first. We're always watching the market first, guys. And when the S&Ps put that nice little candle in down there, wick, filled the gap, I thought, well, maybe it's time for a little relief bounce here. What would I buy? Well, oh yeah, that's right. LRCX was really strong this morning. And as I pulled the chart up, as fate would have it, it's just one of these beautiful entries that we like to look at here on the fast line moving average, the 10 period, which we will talk more about, of course. We are momentum traders, and I call this the momentum line, and we use this line to dictate entries and exits of momentum plays. So getting back to the trade here, market's getting ready to make a turn. What am I going to buy? Well, sure, you could buy the SSOs, which is the double ETF. You could buy the spiders, which is a single ETF. But why not buy something that I know is really strong? And as you can see, when we got a bounce here in the market, we had three nice explosive candles. In other words, nice long candle. The closing price was at the top end of its range pretty much on each candle. So we got a very, very nice explosive move at the time the market was moving higher, simply because we knew this entry point right here was on a stock that was showing great relative strength in the morning, and the market's getting ready to turn. So whenever the market's getting ready to turn like that, anything that's been showing up some good relative strength is going to have some additional pent-up direction in it. And same goes, to the downside for anything that you've been watching that's weak. And as soon as the market rolls over, watch out. So relative strength. And I just think that's a great observation, a great illustration here of when to buy. There's two great buy points on this chart, right there and right there. And I like it because, it's before lunch. It's the right time of day. The first 3 hours in the morning, or first 2.5 hours in the morning, where we usually feel the strongest about our moves. And two great buy points here, one right there and one right there. So in all honesty, when we're sitting here trading and we're seeing this candle shoot into lows, we're just not thinking about buying LR6 right now. I don't care if it's going to highs. The market's going to lows, and I'm concerned about it. So once we get down here and the S&Ps feel like they're ready to make a turn, it's just a no-brainer. If I pull this up, I'll buy that every time. All right. Let's go to the next slide. Our favorite technical indicators. We talked about this last time. We try and keep it real simple. We just use basically three indicators. The moving averages on a 5-minute chart. Simple moving averages, not exponential. We like to keep it simple. 10, 20, and 50. And then also on the daily chart, Andy does have a 200-day moving average, which primarily shows major support and resistance on the daily charts. 200-day is a real macro type of a signal line versus the 10 period. Volume, we always talk, volume doesn't lie. People lie, CEOs lie, analysts lie, stock analysts lie, but price and volume never lie. So we always pay attention to volume. And then the last thing we use is simple slow stochastic, and we'll talk about some trades on that as well. And Andy has his stochastic set to values of 8, 3, and 3. So any stochastic is going to ask you for those values, and 8, 3, and 3. I think percentage D is one of them, and percentage K is the other. So again, just to refresh everybody, those are the three main indicators we like to use. Okay, going back to the momentum line, like I said earlier, that yellow line is the 10-period simple moving average. We use it on the daily chart and the 5-minute chart. This is a 5-minute chart here. And there's a couple things that stand out. This is a Yahoo from, is it from Friday?
I think it's Thursday.
Thursday.
Yeah,
It's Wednesday and Thursday. Here's Wednesday. Here's Thursday. Okay. So a couple things stand out to me on this Yahoo. Let's go to the most recent day, actually, right here. This day right here. Yahoo basically gapped down about, 50 cents or so. And you can see, here's the first 15 minutes of the day, very, very wild swing. And as soon as it got close to this downtrending 10-period moving average, it backed away. So it didn't even touch it, actually. It was real close to touching it, but never even quite touched it. When I start to see this action, it's beyond momentum. It's like super momentum. It's not even touching the moving average. And so this, to me, is guiding the price down. And I'll tell you what, in a bear market, guys, which is what we're in, and I don't care what stock it is, but when you're in a bear market and sellers are ruling this market, anytime I see a setup like this where the stock is below its moving averages and coming up into moving averages, I'm either thinking short right here, or if you were on your toes and happen to buy the open, you got to sell right there, because once this moving average comes into play, you can see how it just dominates the price once again. And I'm always watching this, whether it's the spiders, I see we're coming up into resistance. That means basically get ready to sell your longs and get ready to go short. Now, on the flip side over here, Yahoo opened up above its moving averages this day and never really looked back. Just a great example of how this market's been lately, what a difference a day makes, But chances are we had an up day in the market here. So here's the first 15-minute range of the day. Look, that's a giant range right there to be careful with. There's another pretty big range. And then Yahoo settles in, kind of flops around its moving averages here, and takes off. When I start to see the bottom of these candles putting in ranges that are still way above this yellow fast line, again, that tells me it's not a momentum play. It's a momentum times 2. I mean, this is a real strong pattern when you see candles that can't even come back and touch their 10-period moving average. And so in this case, I would be, if I was looking to get long a stock like this, I would think, gosh, it hasn't come back to its 10-period yet. I just might be having to look at the low end of these candles. They never put in a lower low on their candles. So you can just pretty much see all the way up. This is showing super momentum. Anything else you want to talk about?
No. I'd like to reiterate, because I've actually learned a lot from you when it comes to these momentum lines and the direction of these momentum lines. And he's right. Don't fight it. If you see those sloping in one direction, we'll talk about maybe being a contrarian when it comes to psychology, but you don't want to be stupid and to fight a momentum line like that on either one that he just showed you. So always be aware, of the direction of those lines and where they're headed, because they can have a huge influence on the price action.
Yeah. There's a couple other things that come to mind here. I think we'll actually come back to this chart for some different explanations.
I'd like to say you can see what happens when it finally did break that. Look at the fall from grace it had when it finally did break that momentum line.
Yeah, and I think we're going to have this chart in another example where we talk about stochastics, but and also bar reversals. So let me see if there's anything else that stands out in this line. No, I mean, pretty much what really caught my attention is in this bear market, until it changes, when you see a stock gap down below its averages, this is the averages pressing down on the price. I would not want to be going long right here, because to me this is like a wall of water just getting ready to push the price back down. So be very aware of these momentum lines. Where are they in relation to the price? Okay. Next. Okay, here's another example of using the momentum line. This was Apollo Group. Apollo has also been in the news. It's a online school, University of Phoenix. Basically, this is the parent company. And I think, can you remember the setup on this trade? We talked about it. You missed it. It wasn't like you wanted to get short, but you missed it.
This is the one I grabbed. That was another sympathy play where I grabbed Seco and Coco. I think I got wicked out of Seco, but I kept my Coco and made some money on that.
Here's the thing. Here, this is where the stock came on the radar. Look at the volume spike here, guys. Okay, followed by pretty violent price action. So something came out here. I think it's some news. It had to do with the budget. Some of these schools are being left out of the new budget, and so not good news. And by the time we saw it, it was down here, and didn't really want to chase anything in here. It just didn't catch our eye. But had we been watching, and we weren't, but had we been watching, and I pulled this chart back up right here, this is the kind of setup where I don't even think twice. Why? Because I know the stock is under pressure. I just watched this thing fall a lot of percentage points on huge volume and some fear, but I didn't want to chase it, and I didn't want to try and pick an entry until I felt comfortable. Well, here's where I feel comfortable. Look at this line, guys. Right there, the wick never got above the line there. That wick never got above the line. Very tiny little candle in there showing indecision, tight range. As soon as this line pushes down on it, it really has nowhere to go but down. So I would take that entry right there every time, every day of the week right here. Because I'll tell you what, guys, I have really yet to see a stock turn around and do that off of a setup right there. This line is so dominating to me. That's why I call it the momentum line. It's my favorite indicator, and I use it a lot. So whenever I see an indication like that, the price just being held down by that moving average, it really has nowhere to go but to drop again. So this would be an entry in which right there where I would be looking to go short using the fast line 10-period momentum line. I think we might have another chart in here. I don't see a whole lot. You know, again, this is the time of day in here where I call midday. You can just see a lot of chop back and forth through there, not a whole lot of a conviction. I like the fact that this setup was in the morning still in our power session here, if you want to call it that. This is where a lot of the good moves take place. As we get midday, I don't start to trust moves in here. They start to breathe and pull back and reset, recycle, and set up for the final hour. I think we have another example here. Did I miss something? Let me just see here.
No, nothing.
I thought there were two charts in there. Oh, there was. Okay, we went through both those charts. Okay.
You go.
Okay. Why look for volume? As I said it earlier, volume doesn't lie. You know, analysts lie, CEOs lie. I mean, just look at Dick Fuld. You know, Lehman Brothers. He said they were fine. No need to raise capital. You know, credit default swaps not hurting them. Subprime not hurting them. Well, he lied. But the point being is price action in the market doesn't lie. And this was an example last week. Boy, there was a couple of tough trading days last week because here's what happened. I'm going to show you 2 days. Going into the last hour, we were so oversold, and we were really looking for an oversold bounce, and we started to get some raise in volume. So we were thinking, great, we're getting a raise in volume. We're getting a trend, maybe setting up for the final hour here. And a lot of people got caught in this. I guarantee it wasn't just us.
I did.
And look at what happened. The market obviously rolled over into the last hour, but the real telltale sign is the volume here.
Even higher volume.
Even higher volume on the sell side going into the close. And that one hurt because we were really trying to hold on to these moving averages here like we talked about. We thought, hey, this momentum line is going to hold. This momentum line didn't hold. Why didn't it hold? The sellers were outnumbering the buyers, as indicated by the volume. So we're always watching our volume. And we actually hung on a little bit too long here. We didn't pay enough attention to this. We were really hoping for a move, and we wound up, I think, selling out down in here. So getting long in here and selling out down here wasn't really a good thing. But we took a chance, and it didn't turn out the way we had expected. Again, next day, same thing happens, even worse. Starting to get some upside volume, starting to get some nice price action going into the close. They're not going to do the same thing to us twice, but they did. And the good thing is we learned our lesson this day. As soon as this moving average here, as soon as that 10 period didn't hold, we were out with a fresh taste of yesterday in our mind. And sure enough, we just kind of we didn't go short, but we we sold our longs and just kind of said this market is a little too treacherous right now. And at the end of the day, we look back, boy, lo and behold, look at that volume, all on the downside. So it's just a constant reminder to us that the sellers are still there. They're still very active, and it doesn't pay to fight the volume when you see it like that. It's a good time for this question, Mark. Does the crossing of the moving average lines have any significance to you? Sometimes it does. Yeah, sometimes it does. And matter of fact, I want to go back to. No, I can't remember what chart that was.
Was it Apollo?
It might have been Apollo. Yeah, you know, when I start to see the moving averages twist down like this, yeah, I start to pay attention to that. It's not so much a trade trigger to take the trade, Mark, but I do. Here's what I always want to see. I always want to see the moving averages fanned out, just like this. Your 10, your 20, and your 30. When you've got moving averages twisted like this, or looking like they are in Yahoo here, twisted around here, twisted around here, if anything, that's telling me stay away. I want to be trading things when you got your moving averages fanned out, your 10, your 20, and your 50. You just really no doubt about where the momentum is on the stock. When you get these moving averages all twisted up here, plus midday, it's just too confusing. Again, look at this big power move. Moving averages are all sorting themselves out here. So anytime I can see them accordingly, 10, 20, 50, where they're supposed to be, not twisted, I'm feeling a lot better about the possibilities of that trade. Okay, so
and we'll get more to your question too, Mark, when we go to a little segment we call wiggle room, where in this market with the volatility being like it is, you have to. I mean, you're going to see wicks, you know, all around those moving averages, and that's where you have to give yourself a little wiggle room. You know, my style, I like to trade sides, and I'll admit I've been getting wicked out a lot in this market. It's easy to do.
Mm-hmm. Very easy, and we'll have some illustrations of that coming up as well. Okay, stochastics. So we're going to go back to this Yahoo chart. There was a lot to be seen on this Yahoo chart. And how do we use the stochastics? Well, they're actually, as far as I'm concerned, they're actually kind of the third checkoff. I like volume, I like moving averages, and then stochastics I'd have to wait, as the third priority. But let's look at a few examples here. There's a couple that come to mind. Let's say that we were just great traders, and we got in this position down here in Yahoo, and we got through yesterday's highs. So we're basically riding this trend, and we're excited because we've never come back to the moving average here. So we know we got a hold of a good one, and we just keep thinking, well, I'll just keep an eye on the bottom end of these candle ranges, and I'll decide what I want to do if we break. And we never did. So you got a pretty good momentum move here. Well, all of a sudden we start to get a little choppy up here. We go to highs and we pull back. Can't go to highs. Go to highs and pull back. Go to highs and pull back. Well, this price action is starting to tell me this thing might be getting ready to stall. Let's take a look at the stochastics. Oh, well, we got a couple things going on here. One, we're overbought. Overbought is anything above this 80% line. Oversold is anything below this 20% line. So anything down here is considered oversold. Anything overbought, up here. So if I've been riding this, I'm starting to see these stochastics getting tired. And once they kind of start to drop down below this overbought line, be careful. And let's just correlate this. It's pretty much right up in here, right where this one big candle falls out of bed. That was the profit-taking candle right there. And you can see that these stochastics are starting to roll over and head down. Now there's another play in here. It's called divergence. And I'm not going to spell it. Divergence is basically the stochastics showing you one thing when the price action is showing you another. And we use the stochastics to kind of see some things that are developing. And in this particular chart, there's two examples of divergence. One is positive divergence and one is negative. Let's start with the negative since we were still on this long trade. As you can see, the price made a high, and then it made a bit of a higher high. Not much, but technically a higher high. If we go down on the stochastics, we kind of read into the internals of this trade. What are the internals of this trade telling us? And I'll explain what I mean by internals in a minute. Here's that first high up on the chart. Here's that second high. Well, we've got a lower high in the stochastics, but we've got a higher high in the price action, and that's called negative divergence. Negative divergence because the stochastics we're keying off of are giving us a negative signal. The price is moving higher, but the internal action is moving lower. So let's explain what's going on there in that internal action. It'll probably make more sense because I think I actually helped Andy understand it a little better last night.
Sure, yeah.
Okay, the stochastics is basically measuring the distance between the top of a candle and the bottom of a candle's range. So we got two candles here. Here's a pretty high range candle, and here's a pretty low range candle. So the first thing that the stochastics are measuring is, what's the distance between this candle? Is it a large distance or a short distance? And more importantly, where is the candle closing? Is it closing on the low end of its range, or is it closing on the high end of its range? And that really determines where the value of the stochastic completes. Each 5-minute candle, there's going to be a calculation which determines the direction of these lines, which are essentially just kind of a slow, rolling, moving average of where these candles are closing in relation to the body of their wick. So if we kind of look at it graphically, you can start to see what's going on here. Let's take a look at this big pullback. Yeah, we were overbought, and the stochastics came down pretty hard, as did the price action. Well, look at these candle ranges here. Pretty good ranges in those candles, and they're all closing on the low end of their candle range. So that's throwing the stochastics down very rapidly. Okay, now what happens is once we get down here, you're starting to see some buoyancy. Essentially, let's see, I guess it was right here. Okay, and right here. Okay. Was that the one I was looking for? Maybe it's a different one.
I think it may have been a different chart. I will like to add to this because I entered that trade right there.
Where? Right here?
1302.
Oh, yeah, I remember.
I had like 3,000 shares, and I was looking for a bigger moves that had such momentum, but like Steve always has to remind me, time of day. Basically ended up getting out for close to a flat on that thing on that next pullback when it did break down through its moving averages there and came down. But
it was a great entry, but it was
a
little too tight because he had 3,000 shares, and
exactly.
it didn't give him enough wiggle room, and unfortunately he did get stopped out of that one. Maybe it was another chart we were looking at.
I think it may have been a Lursix chart.
Might have been this next. Yeah, I think maybe it was this one. No, that's the divergence chart.
Yeah, there's the spiders there. Yeah, that's what.
Okay, it's this one. Okay, yeah. So again, looking at the stochastics, let's just go through a couple more overbought, oversold situations here. Let's say I'm riding the Yahoo here, and it's midday, but I'm in this trade, and I'm up here wondering, well, where are we going? Anytime I see the stochastics up here, and no lack of no real major volume, I'm starting to think, boy, I'm overstaying my welcome here, because they really have nowhere to go but just kind of take a breath, pull back. Almost look at these stochastics as like a ventilation system. It's the market's breathing. It's taking its breath in and out, and so it's just a nice, slow, rolling oscillator is what they're called. So, okay, we did our negative divergence, I'm sorry, and on the next chart we have an example of positive divergence. Okay, so essentially here is price of the spiders making a low, bouncing up, and then making some new lows. But what's going on with the stochastics? Why is the stochastics low down here and then making a higher bounce? We got some positive divergence, an upward sloping higher low in the stochastics, while we're having a downward price action, lower low in price. So let's go and look at these candles and we get a better feel of what's going on, the internals of this particular price action. Here's kind of an example of why I say I like wicks, and wicks can sometimes show short-term reversal points. Essentially, we have a couple of long bars here, but you can see the price action is closing on the upper range of these two bars, this one and this one. And the fact that it's doing that, popping back up and closing the bar at the high end of the range, gives a bit of buoyancy to the stochastics here. So that's really what lifted the internals of this price action. Even though the price went to a lower low, the internals, the digestion of the price action in these ranges of the candles are suggesting that maybe it's getting a little overdone on the downside. And sure enough, that particular trade did move on to base. A couple of nice wicks here, some nice divergence, and based to went ahead to go ahead and move on up. And then again here, you know, if you were long on this Yahoo up in these areas wondering what we're doing, we're having a hard time going through highs, and I look down and I see these stochastics have been pretty overbought for a while. I really don't want to stick around for when they break, because you'll see
there's that volume
hard.
Again.
There's that volume again on the downside. So that's one of the reasons this market has just been so tricky as of late. The volume pullbacks are pretty vicious. Here's something. Let's look at this. I start to see things that I didn't see the first time. Here's our bear market again. We're opening up Yahoo the following day, and look at that.
Yeah, the spiders.
Spiders, excuse me. We're opening up the spiders, and actually, you know what? I'm going to take a quick break, Andy. You want to talk about how this
Sure.
moving average line? And basically, I'm just seeing the moving average, just catching that market by the nose and throwing it back down. I'll be right back in 1 minute.
Okay, no problem. Yeah, that's a good example of what we were talking about earlier in the momentum line there. Now, you did have a wick above it, and once again, we will go into wiggle room, guys. It's very important in this market. I'm learning myself. My style with the size that I like to accumulate sometimes, I'm just getting wicked out a lot, and it's tough because you do have some pretty big moves. For example, would be, I can't use the pointer here, but we're showing Steve's desktop, but you can see that red candle right there pop right above that, put in a high there, but you still had the momentum line just diving down. So you got to be real careful about getting long in something like that. And once again, the downtrend just resumed. Let's see. Looking at the stochastics, there's not a whole lot to read off the stochastics there because it's kind of sloppy there. So there's no real divergence there. But you can see that the momentum line is dominating, and we ended up rolling over and going to lows. And I think that day, that was just a kind of a brutal big gap down day, slow bleed. I think I remember correctly. I was pretty much flat on that day.
So I'm back.
Which reminds me, guys, while I'm talking about it to you, it's a lot of people will ask you, hey, why aren't you shorting more? Why aren't you shorting more? And I do short. I have different ways to play short. I've been making a lot of money off gold lately. That's kind of my short play, and I have been putting in a few shorts. But when you get these extreme oversold levels, I've been at this for almost 11 years now. I've seen many traders blow out in this kind of environment. Anxiety is real high in the marketplace right now, and when you get these key levels that we're at right now, Dow 7,000, 6,500, it's all about capital preservation, and I know that, and I know you can blow up real easy in a market like this. But anyway, we'll talk more about that later. But just wanted to add that while I'm talking about this bearish market.
Yeah, so again, we're in a bear market. The market opens and we're gapped down, and we don't have a lot of room to the upside. And every day I've been saying, boy, here come those moving averages. It's almost like they're coming to get you. And sure enough, if you're taking a chance long, it's time to exit and maybe think about going short. Until the market changes, this has been a lot of the openings start to look like this. And so, okay, this kind of goes similar to what we were talking about earlier. A lot of times, you've heard Andy and I talk about, there's a horseshoe pattern. Well, horseshoe patterns are kind of a stock that gaps up from the prior day's close and never really gets to fill the gap, turns around and runs higher, and many times those can be very nice upside plays. Well, same works on the downside. And I'm not going to call them a horseshoe. I'm going to give them a more sinister name. It's the evil rainbow of death. And this day was such a tough day. I remember this, and I went back and looked at the end of the day. Just a slow grind, which eventually turned into just kind of a long upside-down saucer rainbow. This was a very tough day to trade.
Yes.
And the very next day, we gapped down again, and sure enough, look at that. Start to gap down, start to run right into our moving averages. Moving averages catch up, and that imprint on this. In a bear market, guys, if you can imprint on this type of opening right here, it is not a bullish opening. This usually runs into a lot further decline, just like on the upside. A horseshoe will maybe lead to higher prices. So this is just something that I called out a couple days ago, and I just wanted to take a snapshot of it and show this ominous open when you see that. And if you flip that chart upside down in a runaway bull market, these are the kind of things you'd be buying all day long. But flip the chart back around here in our bear market, and this is the kind of thing you got to be scared of and be selling into all day long.
Yes, guys, if we didn't mention it, you will have, everybody on here will have access to the recorded version.
Okay.
So don't worry about it. If you missed a few minutes at the opening there, you will have access to it.
Yes, and it'll give me about 4 or 5 hours to process the video and change the links on there, and I'll send you guys a link for that, and you guys will be able to keep it forever, put it on your iPod, watch it at work. Who knows?
There you go.
So I wanted to there was another day, same week, different day. Just here, an imprint again, guys. Another bear market trap where you get the bulls long in the morning. And it doesn't take long before this guiding momentum line to press down on the diamonds. In this case, it was the DIA. Same thing, though. It's a market bellwether. And a gap down, pop up, run those moving averages, can't go anywhere. Boy, look out below. And I know for a fact this day was an awful down day as well. So just, again, the reason for these charts was just to kind of imprint on these setups here. It's a horseshoe on the upside, and on the downside, it's a ugly rainbow. So those are just simple little patterns I've noticed in the 11 years I trade, and your gut feelings, and got to pay attention to those. Okay, what were we doing on this one? Oh, this was that particular day that we showed. Let's go back to it.
That was the continuation there.
Continuation. Okay, there's the diamonds. Okay, this is this day right here. It shows you how this day opened up after a gap down and a big, kind of an upside down saucer from the day prior. Let's look at that day right here. So here was the opening of that day, and you can kind of see for the next couple hours the market never got above its momentum line. So essentially these were continual opportunities to short the market if you were shorting it, and you can see never was able to close. A candle could never close above that momentum line until down here, which was consequently right at the noon hour. Right at the noon hour, all bets are off. I hate this time of day. I can't say that more. I hate that time of day. So
except when I take a walk.
Yeah, as soon as Andy takes a walk, we get a big up move. It doesn't matter. Doesn't matter when. So yeah, the purpose of this was to kind of just show how that particular morning setup played out. Beware of those. And
I tell you what, it's a tough trading day, guys, because you do have it's what we call a gap down, slow bleed, and you just sit there and you bleed throughout the whole day, except for maybe a little moment there. And then if you're short, you can see there where you probably get shook out there.
Did you see Leon's question? It's exactly what you're talking about. So let's hit that question.
Oh yeah.
How would you play this slow bleed? He says.
Well, I tell you what, Leon. I remember that day, and I think I ended up pretty much flat on the day. It's tough. They're the toughest days of all. There's no question about it. The gap down and the slow bleed. They just you're so oversold. Every short you enter, you're afraid of each wick that pops above the momentum line. Oh no, this is the move. And you get shaken out a lot, and it's
very hard to play.
It's hard to play, and that's when you just back away. If you do want to short it, you wait for your entries. You play small size, and these are the kind of days where I try to sit back and focus on my alerts and see if there's anything coming through on volume, and you look for stocks of interest, I call them. Stocks moving on volume, you could possibly catch something.
This is one of the reasons I consider the stochastics to be the third most valuable indicator, not the first or the second. You can see how long, if you just go off oversold, overbought, and just use that all day long, you can see how long this trade remained oversold. And we're in a vicious bear market, and there's an old saying that markets can remain oversold longer than you can remain insolvent. So the moral to that story is, like Andy said, if you can't figure out a way to play these oversold bleeds, step away and back away and know that you're winning because you're remaining solvent. Because this market has a way of really kicking some people out, especially the last 2 weeks. We've been so oversold. Like Andy said, you get a point where you're afraid to short because you know that a big market rip can be just around the corner, and if you're positioned way too short, it's going to be painful. So going back to this chart, how do you play it? If you don't recognize this, and that's kind of why I was trying to call this out. If you don't recognize this setup early, you're going to be kind of afraid to pull the trigger for the rest of the day. So if I were playing this one,
what? You switched. You made me a presenter.
I don't know how that happened.
Okay.
You're a presenter now?
It's giving me the option to show my screen.
You must have done that.
No.
Okay, we're back to mine.
Okay.
Yeah, and to answer your question, Greg, these are Pacific Standard Time charts, so lunchtime starts around 9:30. So yeah, going back to this trade, if I hadn't gotten short here in this area, honestly, I would be afraid to short in these areas. Or I really would, because we're so oversold. So unless you're positioned, and let's say you were positioned, let's say that you caught that little rainbow and you saw the moving average coming down on it, and you took some shorts, I would try and stay short as long as I could using that momentum line. Now, of course, it would be hard right here to not want to hit the button and panic out, as well as here. So it has been tough. Has the last 2 weeks been some of the toughest trading you have dealt with in your career? Yes.
Yes, no doubt.
Yes.
No doubt.
No,
go ahead.
I was just going to say, as a matter of fact, we both know a couple of traders that we keep on IM, and they've been off IM for a couple of days, and I'm just wondering, I'm hoping they're okay. I hope they didn't do anything, silly, or they're just stepping aside and letting their veteran gut instincts tell them to just step aside and come back when it's easier. But
No.
to answer your question, these oversold last 2 weeks have just been unbelievable. Everybody's been looking for the oversold bounce, and it hasn't been there.
Mm-hmm. And this is where, guys, as far as it's very important, I went through the 2001, bear market, and I know it's all about capital preservation. I know, I'm down a little bit for the year, but I know I can make it up in a couple of good trading days. And, made some of it back up on Friday. I felt that it was going to be a little short covering rally, just because profit taken and shorts have been pissing in tall cotton, I like to say lately, and I just really thought there'd be a short covering rally there, and there was on the close. Unfortunately, waited the last 20 minutes, but it did happen. I was able to capitalize a little bit on that, but don't. There's been a couple of days where my demons have come out, and I was positioned really well for a huge move, and you saw what happened. Almost just slap down volume bars in the last 45 minutes, and I've been caught in sometimes 5 or 6 positions, loaded up, and by the time I work out of them, given a chunk back or ended up down on the day. But I know, I have to preserve capital during this time, because I know there's just a really good bull run just around the corner, and those are so much easier to trade.
Yeah, Leon, and that's really why the dynamic of the slow bleed days are so hard to trade. Yet you're afraid to short, but going long would get you killed. So you really have no choice but to sit on your hands. And capital preservation, sometimes the best trade is no trade.
That's
and
right.
The worst thing you want to do as a trader is sit there and say, oh man, I can't go short, we're oversold here, but I really want to go long because I'm itching to get into a trade, and I need to make some money today. That's just not going to work. You are fighting the currents, and you're guessing. You got to wait for something that shows itself to give you some confidence and comfort to go into it. So yeah, slow bleed days, gap down and slow bleed are tough, because you're afraid that oversold bounce is going to come and hit you at any moment. But going long is also tough, because there's so many sellers in there that you just never really know how that day is going to play out. So that's one of the toughest days to trade. Okay. This one was one of those days. This was actually the beginning of that one day that had the whole day just kind of be a slow-moving, range-bound rainbow. But in the first hour, we kept noticing 1, 2, 3, 4 wicks above this 75 level. And the 75 level corresponds to 750 in the S&Ps. So a lot of times, just as a side note here, and people in our service hear me say it all the time, the spiders have a real tendency to gravitate to the 50-cent number and the round numbers. Round number, 50-cent number. I'm sorry, this was a round number. But the reason being is they're closely tied to the S&P. And so S&P, every 10 points corresponds to 1 point in the spiders. And so those 10 points are a lot kind of psychological numbers, 740, 730, 750, 700, which we're now below. But a lot of times you can use the round number in the spiders as kind of a psychological number, because it's pegged to the index of the S&P. So that was happening here on this particular day at 75. 1, 2, 3, 4 attempts to get above that 75. And I think we used that as an indication that you see these wicks here. That's pretty much telling you there were some sellers in there, and they were not ready to let this price above 75. So every time the price got above there, moved the price back down quickly and showed up as a wick on the time frame there. So when I start to see wicks in the S&Ps here above a psychological number on the upside, it starts to tell me, be careful. As it turned out, there was some news that came out that day, and it pushed the price higher, which was another reason this market's been so difficult. Had there not been that news, I don't think we would have traded higher through there. But point being is, this is the kind of stuff I start to recognize. And if you're sitting long in a bear market waiting for the market to move up, well, you had 1, 2, 3, 4 chances for the market to move up, and it told you 4 times it didn't want to. So these are the kind of warning signals you got to pay attention to. Any other comments?
No, that's a good point there. Yeah, he's real good about finding those wicks and observing them and watching the price action. And basically, all it's telling you is every time it gets up to that level, there's sellers just waiting in the wings.
And the reason there's wicks up there is because it's showing you an element of time Each candle takes 5 minutes to develop. And it doesn't matter if it printed up there 1 second or 2 seconds. It has to put up a wick and show you that transactions went off at those levels. But time is very quick, a very quick moment in time, because the sellers throw the price right back down. And so those wicks really tell me where there's existing supply or demand in a stock, even to the downside. So always pay attention to those wicks, especially above the round numbers in the S&Ps, telling you that there's a lot of sellers up there. Okay, entry and exit strategies, when to buy highs and when not to. You know what, I'm going to let Andy kind of explain this one, because this was a good trade that he was in, and this was an example that he shot over to me, so go for it.
Okay, yeah, this is, there's not too many times in this bear market, guys, where I'd advise buying highs. It's just, well, you prefer to wait on pullbacks, wait for, look for your price and your entry. But this is a case where, you possibly would want to consider buying a high. Okay, you have a stock that gapped down on the day. I would like to add that its peers, POT was having a good day, IPI, and Mosaic was kind of lagging a little bit. And you had a level there at 40. 40 is a big number. You go back and look at yesterday's close. Right at yesterday's close, you had that resistance level there. It could never get above that 40 level. And you had the stock in a nice little trend, although it was sloppy, going back and forth, below that momentum line, and it really couldn't get any action right there. But as you see, as it finally crosses through that 40, and you see that green bar, and you look at the volume coming in, and that's the key. You want to look for volume. I mean, there was a huge increase in volume. You had about 5 of them in a row there. That's definitely momentum. This is a case where, yeah, you'd consider buying highs. I mean, you want to, and once again, there's no doubt the volume is the key, but you also had a significant level there at 40. You had that resistance going back to yesterday's close. I'm not sure exactly what the number was, probably around, I don't know, 40.10 or something like that, but that's a situation where, you want to buy highs. But the key is volume.
The key was volume.
If you see it going through and you've seen it making the same size bars that you
like
saw
down
in
here,
previous, 20
like
minutes.
down there.
Yeah. And then you say, you know what, this is a nice looking chart. I'm going to look for my entry. Throw a bid out there on a pullback, small size, and look for your entry. But if you see that volume, this is a situation where you may have to chase.
And let's just say you did take this trade, and you're in volume, and all of a sudden you're noticing, hey, look at this. Once again, this momentum line is doing better than even holding. We can't even get the candles down to the momentum line. So once I was in this trade, and say I'm in this candle here, I'm looking back going, boy, we're not even close to this momentum line. I got to stay with this thing, and we'll use what's called maybe a bar reversal. It's a good question. I just saw Greg say, when do you decide to trust volume? Look at what happened at the end of the other day. Okay, so when do you decide to trust the volume? Look at what happened at the end of the other day. Exactly. We trusted the volume the other day, and it didn't work.
Right.
When do you decide to trust the volume? Well, looking at this chart,
I will say in this case, this was a much higher percentage change in volume than what we saw on the other day at the close. We did have a little volume coming in there, probably people like me looking for a bottom, and but it was not the percentage change in volume that we had here. This is actually extreme volume. These volume bars are, if you look at those volume bars, they're 5 to 10 times greater than the previous volume bars. So that's and look at the close, that huge green bar there. But anyway, that's significant volume. It's hard to see it on this chart, I know. But if you look at the previous bars, these bars are anywhere from 5 to 10 times higher. Same thing goes as the close yesterday. I was trusting that volume coming in, even though it's just short selling. I'm definitely not calling a bottom in the market, because I think that was just short covering yesterday. But this is a case where, I mean, and not only that, Mosaic was coming through my alerts, constantly coming through my explosive up moves alerts on my trade ideas.
So you knew that there was already some volume in that
volume
thing.
coming in there. Okay, those volumes on the close where I got caught a couple times with my pants down, they weren't explosive up move volumes. So I'm always kind of watching my alerts, and you know, you will if you watch the volume and the price action, kind of like on yesterday's close, there's going to be a big bull run soon, and I know through experience know how to spot that, and know I can really capitalize on it. But you have to watch, you know, when you see that volume, you know, take it yesterday for example. If we were on a regular trading day and not like on a Friday close, I thought that was just short covering. I'll stand by that. But if I saw that kind of volume on like a turnaround Tuesday with an hour and a half to go, you know, I'm all over that. I'm loading up and I'm holding probably to the close, you know, and I plan on really scoring big. But it's just something you get a feel for as you develop into a better trader, and this is a case, you know, this Mosaic where it was doing, you know, like I said, 5 to 10 times above the prior bars.
So all morning it had been coming through your explosive alerts as showing doing regular, normal, more than regular volume today, as it were. So it was already on your radar. And I think that's also a fair point. This volume increase is significantly more than the volume increase we had in the regular general market going into that last hour. That market was just kind of a drift up higher in volume. It wasn't an anomaly or a spike in volume. This was much more of a spike in volume. But that's a fair point, Greg, and that's one of the reasons the market's been so hard lately is what do we trust and what do we not trust. And in the case of those last 2 days, we took a chance and we were wrong, and so we had to draw our line in the sand and just take our hickey and accept that we were wrong on that one.
When we get into the question answering segment of our webinar here, I will we'll switch over to my screen and I will be able to illustrate more what you're looking for in volume, and we'll be able to see more of it. I'll have my e-signal up so you can kind of get a good idea. You can see the volume we had yesterday at the close versus the prior days where we had a big breakout and then sell off hard.
What's this blue line on your charts? Is that like a volume average line or something?
Good question. I don't know.
I don't know either.
Yeah, it may be. I don't know.
Maybe taking the average for that day. I'm not sure. I've never used it. Okay, the oh shit bid. Well, this is a fun one. This is something that you know, can be done in a trade where, okay, let's look at this one for an example. Let's say you felt, oh man, look at that breakout. Same example as the last chart, breaking out from yesterday's resistance levels, breaking out on some pretty good volume. But let's say we didn't pull it up until here. And like that example I drew earlier on chasing a stock like Halliburton, well, no, we're not going to chase and jump in and buy here because more than likely we're just going to be having to nurse this thing for the next hour as it pulls back as expected. But what if you really were paying attention to this volume and you really wanted to be in this stock but you didn't want to chase it? Well, where's the best place to maybe throw an a bid? Sure, you could throw in a bid here and maybe that prior reversal, like I said earlier, if you really wanted to get aggressive and get into it. But you would have got into it here and, you know, maybe you would have been excited, but eventually, look at that, it had just a nasty pullback. And so what we call an oh shit bid, or sometimes take a look at a pullback and then look at the next level, even worse. And in this case, the level from which it broke out was essentially that level right there. This is pretty much the breakout level. These people that bought up here had to sit through an hour and a half of digestion before the stock actually moved higher. Where we would have considered putting in an oh shit bid, and the reason we call it an oh shit bid is because sometimes it'll sit out there for an hour and you forget that you have it, and all of a sudden the stock pops up on your screen and you completely forgot that it was out there, and your first reaction is to say, oh God, oh shit, what just happened? And more often than not, those entries are going to turn around and be in the positive, in the green for you, before you even have time to realize what just happened. Nice little quick wick there, very quick moment in time, and it came back and it touched this area of breakout. Well, I think this was an actual trade, wasn't it, Andy? Did you do this one?
Well, I was actually in this trade. I actually set through pain. I think I had about 6,000 shares of AMAT.
You were one of the buyers right here, right?
I bought the first pullback on the yellow line there.
Okay, so Andy bought the pullback here. Okay.
Yeah, so I had to sit through a lot of that. I love the trade. It was a momentum stock, but I set through a lot of pain in that red bar. I didn't punch out because I didn't see the volume coming in. I knew it was just kind of a reaction to what the market was kind of doing at the time, being very volatile. So luckily I stayed in the trade and was able to make some money on it. But this is a case where, yeah, you throw out a bid and you forget about it, and you don't want to do huge size. You just do small size, and man, I can't tell you how many times those work. I just throw them out. I did one yesterday in gold, and sure enough, GLD. Sure enough, came down, boom, hit me, 200 shares. What I was already in it. Put in another bid for some more. Forgot about it. 30 minutes later, whack, I'm getting hit. The market's turning. I just can't tell you how many times, but 90% of those times are winning trades. And you have to be careful and do small size, especially in this environment. But it works on the short side too.
And let's say you're trading, you got maybe 1 or 2 shit bids out there, and all of a sudden some bad news comes into the market, and we start selling off hard. There's nothing wrong with going in there and changing and just canceling those bids because there was a material change in market direction before you put that bid out. If everything had remained the same and the market was just churning back and forth, these stocks have their own little moments of brilliance and moments of anger. And then this one, the market really wasn't doing anything, so it would have been okay to leave an oh shit bid out there just for fun, just to see if you can get it to hit. And most of them will probably not get hit. But like Andy says, the ones that do get hit, sometimes it's an immediate winning trade, and you got to figure out basically not when do I sell it for a loss, but when do I get out of this thing and when do I take profits on it. And we'll set this up here for the dynamics of the psychological part we're going to go into here in a few minutes. But let's just take this from an example of a guy who went ahead and bought right here, and he didn't take his profits. And he sat, and he sat, and he sat, and then he got excited again, and then, oh my God, are you kidding me? I can't take this anymore. He's probably one of the guys that's selling out here for a flat or a small loss. And all you're doing with an oh shit bid is taking all the emotions out of it and just sitting in there looking at the technicals and just playing it in a complete Zen-like fashion and saying, well, if anybody wants to cough up their shares at this price, unless market conditions change, I'll take it. And you forget about it. And before you know it, this guy is totally frustrated, and he's coughed up his shares to you only to turn around and see his shares go higher an hour later. And I'm sure people out there can relate to that happening. So any time where you can set an alert, if your software allows you to set a price alert, or even better, just go ahead and put a small size bid in there, it'll get you in the game, get you on the radar at a much better entry price, and it'll give you a lot more time to decide what you want to do with the trade versus the guy who bought the guy who chased the stock up here and was waiting for the herd mentality to tell him everything was safe, come on in and buy me, and just about the time you feel safe, the herd changes directions on you. And so finding a way to be creative and entering some good levels at oh shit bid is one good way to do that. Let's see if there's anything else that catches my eye. Here's another opportunity at an oh shit bid. Basically, we had another breakout above 940 and a pretty big move up to 980. Well, not wanting to chase it up here, if you were still looking to want to get long in this thing, you could go back and say, well, maybe I'll use the moving averages here as a possible pullback point of pain. And sure enough, a lot of times when the 10 period fails, you can see it tried to hold there, but it had a nice wick and closed on the bottom image end of its range and moved right through that candle. But the secondary, or the backstop, is the 20 period. And if somebody had said to me, hey, Steve, I want to put a no shit bid on this AMAT, where would you put it? I would probably look back and immediately say, well, you could take a chance at the 10 period, but more than likely, if you're going to do an oh shit bid, put it a lot lower and put the worst case scenario in there, and I maybe would have considered this area of breakout and this 20 period as another good area for an oh shit bid. So that's enough on those. Yeah, just going back, it looks like the crosshair was that thing. Yeah, it makes sense. So the crosshair. All right. Wiggle room for wicks. I'll let Andy talk about this one because essentially it's been a tough market to not get wicked out of, and we'll explain why here.
Yes, I was mentioning that earlier, how easy it is to get wicked out of good trades, and it's been happening to me way too frequently lately. But this is a prime example if you're in this Versix, and if it's a nice momentum chart here, and if you were to say, well, if it breaks that momentum line, I want out. Well, you can see there's a couple of cases right there where it broke that momentum line, went down about another, looks like maybe 3 to 5 cents lower, and it just popped right back up and closed, the bar closed higher. So what you want to do, guys, you want to definitely give yourself some wiggle room in this market. So cut back your size, do whatever you have to do, because it's so easy to get what we call, we have a phrase we always use on our site saying, "Don't whip me, bro," and because I've been getting whipped out a lot. So what you want to probably do, guys, is if you keep it tight, I can guarantee you in this marketplace you're going to get stopped out. What I've been trying to do lately is give myself another, depending on the stock, it could be anywhere from 3 to 10 cents, 11 cents, whatever. But give yourself some room for the wicks and the wiggles, because it's going to happen. And if you keep it really tight, right on those lines, whatever you're using, if you're using a support, resistance, and just give yourself some wiggle room because
the reason being is there's so much emotion in the marketplace right now, and especially in individual stocks. You're having extreme movements back and forth, and it's creating a lot of these wicks where we go through and blow through support and resistance and pop right back up. And so the point being here is don't look at, let's say you're long the stock, don't look at this line and say, okay, this line is exactly $9.53. So if it touches that $9.53, I'm out. No. In that case, I would say put your stop at 48. Give it another 5 cents. And if that means taking a little smaller size than you normally would, it's probably going to save you a lot of good trades of getting out too quickly. Kind of like that example we talked about earlier in Yahoo when it came down and was oversold and Andy jumped into 3,000 shares of it and he got stopped out within like 3 cents. He had a big size and he was looking for big move, but at the same time he was trying to protect his downside. And point being is if you need to give yourself an extra 5 cents or 3 cents, which I am recommending in this market, make sure you don't have too much share size to where that'll start to hurt you in the long run, because this market has had a way of overshooting and then popping back up. So it's not an exact science is my point. Give it a couple extra cents wiggle room. Same goes on the upside. If you're trying to short a stock, give it a couple more cents to the upside. Let it go through those moving averages and give it a chance to maybe wick, because that's really what one of the hardest parts of trading is when you're in a position and you're trying to decide, do I want to sell here? Do I, let's say you're long up in this area and you're looking at this moving average. Well, if it breaks that moving average, I'm out. So if you put your stop right on that moving average, trust me, these things are having a way of going through, taking a look, finding out what's on the other side of these lines. If there's not enough sellers, they bounce right back up, and it's a horrible feeling to be one of those people that just got pennied out for the want of a penny or so. So in this market environment, it's a little sloppy. Give yourself a little bit more room for exits. Taking an entry on here is fine, but I think in terms of putting in your stop losses, some money could be left on the table by making this an exact science and getting it too tight. All right. I guess that's what we wanted to call out on that.
Mm-hmm. Yeah.
Okay. Scaling
I'd like to add, actually, on the short side, the wicks are even more extreme, because not only, like you said, these up moves, not only do you have people running the cover of the shorts, you have new buying interest that's possibly coming into the stock, so they can even be more volatile to the upside.
I would recommend that. And let's go a step further. Let's say you're playing the short side on a weekday and you don't want to chase a short down, but you see it's following its moving averages. Well, you put an oh shit offer. Put an oh shit offer in there, not right at the moving average, but maybe a little bit above, and try and be one of those people that's ahead of the game and ahead of the herd in catching somebody's short side pain and having to buy to cover to get out because they can't take the pain anymore because maybe they chased it. But you're sitting there waiting for them to cough up their shares and give you a much better entry and give you time to decide if this is a good entry point or not. But again, Andy's point is to the upside, there's probably even a bit more wicking to the upside because of the nature of the short sale right now. You got fresh buyers coming in and panic shorts coming out, both of which are buying, and that can push some extreme levels on the price action sometimes to the upside. So yeah, I would agree with that. What Andy says, there's a little bit more sloppiness and wicks to the upside right now.
Mm-hmm.
Okay, there's a couple things going on this chart. And I'll let Andy start with it because
Okay.
this was the trade that he took. It was Friday, right? It was yesterday.
No, it was Thursday.
Thursday. Okay. So let's go ahead and talk about basically we were looking kind of like the horseshoe setup here, starting to develop. Well, what do we do with it? Gap up, came in, filled its gap. It's starting to head higher, and I'll let Andy walk through the trade there.
Yeah, this is a case where I mentioned that, a lot of times I'll play the short side about trading gold, and this is a day that the market was just getting destroyed on, and gold was holding up nicely. I think I entered my first 500 shares around that area around close to 90, 89, 90, I believe it was, and just a small size. Scaled in, and what happened is this is a good example of why you should scale into it. Had I took my full size on this one, I really like this setup. I really like this chart, and this is cases where you want to press it up, and everything was setting up nicely here. So on that pullback there you see the two moving averages there, right? Pretty much, right there coming together. I bid another 500 shares. And I got hit on that pullback. Well, it held on there nicely, very firm on those moving averages, dipped a little bit below them, and then it started moving higher. So, now I'm in half my position. I want to get 2,000 shares of this. Well, the pattern started to develop more. You see the cup and handle, nice little cup and handle, and as it moved higher, I believe what I did, I had half my position, and what I did is once I felt it, I real good feel that this was going to go, I bought another 1,000 at 89.98, I believe it was, and just that was more kind of gut feeling. The market was continuing to roll over. Gold was just setting up so sweet. A lot of times you have to use your gut feeling, not wait for the confirmation to go to highs. And at this time I had 2,000 shares, and then it went to highs. You can see the volume coming in. But this is a case that had I bought my full size, and this was a lot of gold to be buying, 2,000 shares, but had I bought 2,000 right in my first entry there, I would have been panicked out and got out there at the bottom, because I'd have had too much size. So, but since I was only buying basically a third of my share size at a time, or a quarter in my first two entries there, and then I got a good gut feeling that it was going to go, and I bought another 1,000, and then had a nice little move. The problem I had in that trade, it ended up being a really nice trade, but I sold 1,000 of it too quick, because it just, you get to, that's something that we all should work on. But I did hold that last 1,000 for, I think I sold my last 500 right close to 91 up there. I think when we finally had a bar reversal, right? I think Steve will point out that bar right there. That's where I got out my last 500. But and of course it went on. I should have probably bid back into it down there, but I didn't. I let it go.
You're running into midday.
Right.
Running into midday. This was the meat of the move here, and a lot of times we make good mistakes of catching a really nice trade and then wanting to go back to what just felt so good and what paid me so well. But you go back to the same trade, and really this moment in time is gone.
Yes.
This beautiful cup and handle is a momentary period in time, and Andy played it correctly. Scale it in a little bit here. Didn't get too much in case it pulled back. Well, it did pull back. And I think what you forgot to mention that you knew that pretty much if it broke these moving averages, you're going to be stopped out. So what he'll do sometimes is he said, well, since I know I'm going to be stopped out at here, and we're a couple cents above here, I'm just going to buy another another batch right here. And if that batch rolls over and goes through lows, then it's a very low risk scale in, and you're out of everything. But in this case, it held, and then like I said, that pattern became very nice. I mean, cup and handle pattern. And let's not forget, like Andy said, it's worth pointing out, the market was going to lows, and gold in this case was a flight to quality. It's been a flight to safety. Seems like when the market goes to lows, there's a lot of interest in gold. So essentially, we were playing the market weakness, just using gold as a vehicle for a nice upside setup. Now, you're not going to see a lot of setups like this in a bear market work in equities, because they're going to be under pressure. If you look at gold on the daily chart, it's been in a nice upward trend. So these cup and handles on the upside tend to work a lot better with stocks that are having upward momentum. And in the case of gold, gold is in a bull market. The stock market is not in a bull market. So this type of cup and handle formation, more often than not, may fail if you're just buying a stock because you like the way it looks and there's no other real reason other than the cup and handle, be careful, because in a bear market, those more likely than not will fail. But knowing that gold has been an extreme bull market and it's a contrary play to the downward pressure we had in the market at that point in time, that pattern did hold up. So I think that's a very important point to recognize. You can't just go in and trust a cup and handle in a bear market and say it's going to work because it's a pattern. It's just one of many facets. The market was rolling over to lows here as Andy was getting long this thing, and I think that's all I wanted to say on that.
Yeah.
But
the point is, in this environment, try to use the scaling in and scaling out approach, because the volatility is just so huge, and things are changing on a dime. So if you just use that scaling in approach, you'll find yourself being a lot better trader. And I actually need to do it a little more.
We were laughing last night going through these slides that this is actually beneficial for us too. It's reminding us. It's reminding us. Because sometimes we do tend to forget. You get caught up in the emotions, which you're not supposed to, but you get caught up in all the different cross currents, and you got to kind of remember what the basics are. And so it's good for us to go over the basics once in a while here too. But again, I can't stress enough, don't trust this pattern unless we're in a nice up day or a nice bull market. The reason this pattern worked is the volume and the bull market in gold. So what you're going to see is just the exact opposite in some stocks. You'll see them hit a level, kind of bounce up, and then make another attempt at going lower. And all that really is an upside down cup and handle.
Right.
So it's the exact same thing. You just got to get your mind to flip that upside down. Okay, stop losses, letting winners run, and keeping losses tight. The ultimate. Here we go. Same chart again. And I guess we kind of already hit on that. And he sold his first 1,000 here, which was a bit regretful, I guess, in hindsight. But at the time, there's nothing wrong with taking profits. But as you'll notice, look at these candles. Again, they're all putting in higher lows on the candles. Here, 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 and even here. But this is where we start to get some wicks. Look at this on the upside, starting to tell us that, hey, look, there's some sellers coming in quickly here, and the price isn't lasting very long above 91. So at that time, Andy said, well, I'm going to put a bar reversal in, and this is how you lock in profits and trying to let your profits run. Everybody says, cut your losers early and let your profits run. Well, here was an example of cutting your losers early. If this level didn't hold, we were going to be cutting that trade, but the level did hold. And so take profits on the first half. Again, you can't fault anybody for taking profits, but that second half, which we do many times, to try and let work, did work. And at what point do you decide enough is enough? Well, saw those wicks up here. It's time to look and say the next time a candle trades below the previous bar's low, which in this case was right there, I want out. And so here was the stop right there. That wick right there stopped Andy out. And as you can tell, it was a good trade because for the next hour and a half, it did nothing. So here's the meat of the move. Take your profits using a bar reversal for the last bit that you still have that you didn't sell out on the way up. And that's the bar reversal. That's a good way to lock in profits and try and let them run for you. Any thoughts?
No. Just it's key to go ahead. You guys, if your software will allow you to do it, put in your stop losses. Like on that gold, I did add to my position down there. Which, if you're scaling in, guys, there's nothing wrong. We talk about this. You don't want to average down losers. But at the same time, if you're scaling into a trade and in a good position and a good chart pattern, there's nothing wrong with buying a little more of a stock, lower than where you bought your first little chunk. Because I'm taking on my position, so it's not like like I said, if I'd have bought 2,000 up there and then it pulled back down and then I bought another 2,000.
Well, yeah, I was going to draw.
I'm doubling down.
Let me draw the anatomy of a bad trade when it's an actual averaging down.
Right.
In other words, you're not admitting you're wrong. You're doubling up and hoping. And doubling up and hoping is not going to get you anywhere trading. So, had you bought like a full 2,000 shares here and said, okay, my stop loss is here. Well, the price went through and he didn't sell for whatever reason. He's a deer in the headlights. Okay, well, now we're down here. I'm going to go ahead and double up down here just so I can lower my average price. No, this trade's broken. It broke through the handle. It broke through the area that you decided earlier on would be a stop loss. if you start changing the game and changing the rules, being a deer in the headlights, and then averaging in down here and hoping the price is going to go higher, it's not going to get you anywhere. You've got to have some discipline on your scaling in and your scaling out. So hopefully those two are a good example.
Let's see. Hamilton thinks he sees
Yeah, I'm looking at that. Let me see. Negative divergence there in the stochastics also. Negative divergence. I guess you're talking about up in here, Hamilton.
on the exit. Oh, yeah. Good point. Good point.
Okay, yeah.
Very good. It's a good eye.
The stochastic, the internals of the price action, and I'll tell you why. Because of those big wicks up there. Those wicks are showing that the price is closing towards the low end of its range now. So you're getting a deterioration, a degradation in the stochastics as the price moves higher. Very good eye. Thank you, Hamilton. All right, here, let's see, what time is it? Oh, we got about 10 more minutes for, I think we're getting close anyway here. Again, here is another example of a couple things. This was this week, this week and last week, actually. We talked about Apollo, University of Phoenix, some of the online private schools were getting hit, and they had a tough week. There was a lot of sell pressure last week. So we're going to look at the anatomy of a couple of trades we took here. This is going back to February 26th. Again, Apollo was having probably a tough day, and we were focusing on some sympathy plays. This one was in CoCo, Corinthian Colleges. And real simply here, this is why I use a 5-minute 3-day. This is going back 3 days. I like to see things like this. Whoa, look back here. On this day, the price did not get above 20. Okay, that's an interesting note. And also down here, we had some price congestion at the 19. Well, that's interesting as well. So we traded above 20 a little bit, and then we could not get the price action after a bounce. Big sell-off on the open. Bounce, bounce, bounce. Little wick right there. You can't see it, but a wick above 20. Couldn't get through, and it's starting to roll over. This is where we took a trade right here, because I saw Apollo falling out of bed. I saw CoCo with this volume here increasing, and this little wedge. It's called an ascending triangle, kind of a flat upper top, but rising bottoms, and many times this is just a continuation pattern to the downside from which it first came. So as soon as it broke out of this ascending triangle, we took a short position. So now that we're in this position, the whole key here on this one is letting a winner run. What I saw was, going back on my 5-minute chart, I saw, well, this line didn't hold, and that's consistent with 2 days ago, and it looks like this congestion down here is where we're headed, because looking back on all of this, there's not a lot of support and resistance there. That's kind of a void. And this is the area we were entering, into this void. So I thought for sure a good downside target on this trade was 19. And I remember saying to Andy, we got to let this thing run to 19. And we did. And it was a good trade. It did go down to 19 and eventually caught our price objective. So there's an example of, if I get out to here, I'm probably leaving a lot on the table, because if I look back in the past history, yesterday and the day before, we're in a range from 20 to 19, so this stock was pretty much just on its way back down to the low end of its range. And that's what I saw. I forgot what the next slide is going to be, but
I think it's going to be the continuation.
It puts it in perspective. Okay, this is a daily chart. This is a daily chart of that same trade, CoCo, but it's a couple days later. Here's that trade that we were talking about. I'm going to isolate this candle right here, and I'll erase it. So that big red candle is that trade that we were just looking at a last minute ago. And as you can see, it did go to 19 very easily, but it went a lot lower. It went to 18. And we left some money on the table, but that's okay. That was a pretty big move, and I'll take that move any day of the week. But, going back on my daily chart too, I could see this 19 level was kind of a pivot back here as well. We had a top of a candle there. We had the low end of a wick there. We had already had this down candle and this up candle, but I knew that was a pretty good level of support. So here's an example of using your daily chart in addition to your intraday chart to marry up possible price target objectives. And then let's go forward one more here, and I think it further puts into perspective what this is. This was that same day, guys. Here's that descending triangle wedge I drew. Here's that little wick above 20 on that trade we took. Here's where we got into the trade in this area, and we covered down here. Started to see some congestion and I think we covered most of it down in here above 19, only to see that, boom, we left a lot on the table, but we didn't chase that. We just kind of watched in amusement as it went lower. But there's an example of how that day actually turned out. when all we had to go on that earlier slide was just this breaking here and getting short. What was our downside target? Well, using those 5-minute charts to go back and see that that was our downside target. Pivot, I'll call it a pivot level. And okay, so we're getting kind of towards the end of the charts, and we're on time here. That's good. So a couple more thoughts here on trading. We talked about earlier a slow market bleed is a tough market to trade. Well, you can either try and fight it, or you can recognize it for what it's worth and scalp very tight, very small positions, or just sit on your hands. And that goes the same for waiting on market direction. You know, if you're not comfortable with the way the market's trading, you know, go to this type of a strategy. If the market is not trading in any direction, just chopping back and forth and twisting through those moving averages we talked about earlier, you got two choices. You can either scalp small size or sit on your hands. Sometimes the best trade is no trade, and cannot emphasize that enough, especially in this market. And trading a bear market, did you have something you want to add there?
Well, I just want to say, yeah, knowing when to ramp up, that gold trade was a prime example. You know, I had a really good feeling about that, you know, and so I did ramp up my size, bought a couple thousand, a lot of shares to have with GLD, and but I love the setup. I love the price action. I got a feel, and not only that, we should have probably shown the daily in there, and it had a bar reversal at that 90.35 level. This is a stock that hit a 52 high.
We'll do that when we go into a question.
Yeah, I'll show you on my screen. Yeah, it hit and had a beautiful, you know, bar reversal. And unfortunately, I that the high of the previous day bar, I think, is where I sold my first 1,000 because I was just, you know, I'm not sure we're going to do the whole reversal here, but it ran right through it pretty hard.
So we talked a lot about in a bear market. You know, I said don't trust those cup and handle patterns. You know, in a bear market, it's tough to trust. But you know, that gold trade was a nice upside bull market move and a momentum play to the upside. So that's a little different. Other things to avoid, you know, in a bear market. You know, as I said earlier, a lot of stocks are going through some tumultuous times. There's insider selling, there's forced liquidations, and every stock is having a bit of panic on a different set of circumstances. And that becomes kind of hard to handicap. You don't really know what some of the internals of these stocks are, and so when we discovered that, we've been doing a lot more of this in the last few weeks. We just go to the ETF. That's what we've been saying. Just go to the ETF, whether it's the home builders. You know, trade the XHB instead of trying to pick the strong one. Can't even spell. And so we've been focusing a lot more on those, which, you know, kind of bleeds into the double shorts. And double shorts and double longs, you know, for that matter. FAS is the financial triple long, excuse me. FAS is a triple short, and we've been playing more of these lately. I don't recommend playing these for people who don't have a lot of experience. You're better off just playing the XLF if you want to trade the financial ETFs, because the financial XLF is ×1. It's not going to have the crazy movements that ×3, meaning, you know, for every percent that the XLF moves 1%, the FAS is going to move 3. So save these triples and doubles for some of the more experienced traders because they have a lot more noise, a lot more whip, and a lot more action, which means they can hurt you just as easily as they can pay you.
Right.
But we have been focusing more on those, especially, and the reason being, in the bear market, you got a lot of individual stock stories going on that we may not all know what's going on behind the scenes, forced liquidations, things like that. So just playing the ETFs is a lot more advisable in these market conditions. It just takes out some of the noise. And you know, a couple other good doubles and triples. I'll just spell them out here for you. The SRS, you know, if you hear commercial real estate getting pounded again, the SRS is a real estate short, and it's a double. It'll move twice as fast as some of the other real estate ETFs. SMN, basic material, double short. If you see steel and basic materials and other basic commodities going to lows, the SMN is a nice fast-moving double ETF, which will move higher as the basic materials move lower. So there's a lot of new vehicles out there that the stock traders did not have a year ago. That's one of the reasons we like to trade in the stock market, is we have levers available to us now where you don't have to have a futures account or another account over here. You can use ETFs as a vehicle to trade just about anything in the market these days. You know, TLT, you want to trade the treasury bonds? Trade the TLT. If money's coming out of the Treasury bonds and going down, there's an inverse for that. It's the TBT. So there are tons of vehicles out there to trade the economy and what's going on out there right now, and we've been focusing more and more on those. Lastly, we are in oversold conditions, and the short trade is a crowded trade right now. And in an oversold market, one of the things that has been making us so tentative about loading up short is we talked about the dynamic of short covering. You have fear on the part of shorts, and fear is a very strong emotion. So they're getting out of their shorts by buying like crazy, buying out of fear to cover their losses. And at the same time, you got cash on the sidelines waiting to come in with greed to get in the game and not want to miss the train leaving the station. So those two elements of emotions are coming in at once and make oversold conditions like a dry forest, just ready to be torched. And so in an oversold market condition, sometimes the market does not need much to light a fuse and go higher. And on Friday, we had one of those, and like Andy said, it's not the beginning of anything. It was just more or less the shorts looking at each other and realizing that it's kind of a crowded trade here, and it might be wise to get out before the crowd starts leaving the exits, because once that happens, you're going to lose your price real quickly. And I think we have a couple more slides here. Oh, how to spot a real move. Okay. This, are you there, Andy? Okay. This particular move, it was in the spiders on a day, I believe. I guess this was just, I think this was just Friday, wasn't it? Is this Friday, Andy? Is this yesterday? Can't hear you. Let me bring in the second slide. Okay, I remember now. This slide right here is are you there? I can't hear you. This slide right here is showing volume. And are you there?
Can you hear me now?
I hear you.
Okay.
I hear
something's wrong with the mute. But anyway, yeah, I was.
Yeah, you're the one that put these slides together, so I want you to talk about it.
Yeah. This somebody mentioned, asked earlier. How do you know? How do you know if it's a real move? Well, this is Friday, and I happen to catch this move here. But if you notice, look at the volume. Even though I wasn't crazy about the time of day, this did happen in the last 30 minutes, and this was nothing but shorts taking profits.
Like I was just talking about, guys.
Yes.
Mm-hmm.
And but regardless, I don't care. I noticed the volume. We're sitting at the 6,500 level in the Dow, and just the volume. All I'm looking there is a volume. Even though you see a red bar in there, that's just a wick. You see the big wick in that candle up there. That's not a major pullback. So don't pay so much attention to the color of the bars unless you see a lot of them in a row, like we showed you on the prior days where you just had an immense selling pressure in the last 30 or 45 minutes. This is just one bar, and basically all it is just a wick in the candle if you look up there above that bar. But the point I'm making is you had huge, those were probably the 4 highest bars of the day, and they all came on the close, and that was just short covering. I knew that I was positioned well. And getting back to trading ETFs, guys, this is what I'm talking about. Luckily, I was in BGU, which is a triple large cap ETF, and I'm sitting in that, and of course that's moving with the market. I have made a good deal of money on that, had a couple thousand shares, and but I'm sitting in Yahoo, which was really, I'll show you when we pull up our charts. I'm in like 4,000 Yahoo, which was holding up really well, doing good volume earlier. And then you had a 120-point move in the market, and in Yahoo went a whole 10 cents for me. It's like, and this is a stock that the chart was beautiful, and it was holding up all day. It was up all day, and like Steve mentioned, you don't know what's behind all this going on in stocks, and nothing's more frustrating to be positioned well in the marketplace, but being a stock that's not moving with the market, and that was really frustrating because I thought I'd get maybe 25, 30 cents out of that, and I got maybe a dime out of it. So it's like I'm starting to play more and more. SSO is a good one. That's the double
S&P.
and we'll hit a few more. You got TNA, which is small cap, I believe.
Small cap triple, yeah.
Mm-hmm. But anyway, that's what you look for, and guys, seriously, if you see that kind of volume, and I'm hoping for a capitulation. You know, that's what's discouraging about in this market. We can't get capitulation, and that's why I'm not too excited about that little short covering rally we had on. It doesn't impress me. So you have to be careful coming in on Monday thinking, oh boy, you know, we had a nice turnaround on Friday, we're going to run. I'm not saying we can't. We're oversold. Anything can happen, but I'd rather see capitulation, and we'll talk more about that.
And then here's an example of how when not to trust a move. This is one of those closes last week that we got hurt on, and you can see, like we talked about, that when to trust the volume. You know, there was a little bit of raise in volume, but not much. And I think we were trusting the price action on this one more than we were trusting what the volume was telling us. And so we were long, but then of course you go back and you look. This volume starts to really put that volume in perspective. Had this volume been the volume on the up move, I think that move would have been a lot better, would have turned out a lot better, but it didn't. And so in hindsight, we kind of looked back and said, boy, did we just get suckered into a kind of a lackluster volume move there, because it wasn't really that impressive. That's more impressive.
Exactly.
Unfortunately, we didn't have that volume over here with this price action.
And not only that, the reason I was kind of trusting that move, you look at the market, it had gapped up and it was holding up, trending up nicely all day, and then you had that move. You know, I was positioned for had the volume continued and we went higher, I would have killed it. But once again, the sellers returned at the close, and we dominated the price action all the way down.
We gapped down. Yep, we gapped down the next day open. And what are you thinking right about here? You thinking going long right about here, guys? No.
No, we showed that earlier.
Yeah, but I'm just rehashing it because it's a very important point. It's something I've been seeing all too often. You know, everything we've been showing you here is with this kind of stuff is all bear market, because that's what we're trading right now. This kind of stuff could turn on a dime, and we could have a 1 month bear market bounce or a bull market rally, where you just got to turn these charts upside down, like I said earlier. So let's see. I think we got one more slide here before we go into question and answer, and it is just on the psychology. And there's no more important chapter, I think, in trading than psychology, and this is where everybody starts to have to kind of deal with their own issues and their own demons. You know, I put on here the battleground of trading really is emotions, patience, focus, and relaxation. And there's a lot of things I tell the people in our service that you can't control the market. You're not right. The market's not wrong. You know, the market is right. You just have to adjust to it. And there's really only two things that you as a trader can control. Everything else is out of your control. But the two things that you can control is, one, your share size, and two, your attitude towards the day. And attitude goes towards emotions and keeping yourself in check and recognizing your demons and not getting out of control. So, you know, that being said, I can talk probably another 3 hours on this subject. We don't have the time, and I can't do it justice as well as that book that I mentioned earlier, guys, Trading in the Zone. If there's one thing you do going away from this, if you're trading real money, live money, and you're struggling and starting to realize that you're running into some of the emotional issues of trading, Trading in the Zone will be a really good book to go forward from here on out. Avoiding that herd mentality. You know, we kind of touched on that a couple times this morning, using maybe that Yahoo example on that oh shit bid, where the guy who chased those first two green bars, he was waiting for the water to be safe. You know, waiting for the other people to run out in front of him and see if they got their heads cut off before he runs out and takes a chance. And I'll tell you what, that's just never going to work. You cannot follow the herd. And that's one of the most difficult things we as human beings have to overcome, because that's the way we were wired. We are hardwired. When we see everybody react to something, we want to react to and see what they're doing. When the herd starts running one direction, it's human nature to want to run with the herd. What's not human nature is to be the first person to stand out there and take a stand. And that's kind of what it takes sometimes to do that. The guy who bought Yahoo in that previous example, you know, he struggled for an hour with it. Well, he may have eventually just wound up coughing up his shares to somebody who was trying to play the flip side of the herd mentality. In other words, identifying a strong stock on a good day, on good volume, on a good uptrend, but just identifying a simple moment in time where he could take the shares from somebody who lost control of their emotions briefly. One, because they got in too soon and chased, and two, because they panicked out. They didn't have enough downside risk. So that's a real good example of trying to go against the herd. You're never going to make money being in the animal kingdom, like they say, a bunch of penguins standing on an iceberg watching the other penguins jump in and seeing if they get eaten by a sea lion. You got to be that penguin who's willing to jump in and take a chance. You're not going to make money following the herd. You're never going to catch the inefficiencies that you need to catch to book profits. So I cannot really focus, I can't emphasize that point more emphatically, that yes, it's very hard because we are all hardwired to react to something that's happening. It's just our instincts. But recognizing that that is a detrimental action and trying to find ways to force yourself to go against the herd, whatever you can do, whether it's an oh shit bid or anything you can do is going to help you guys out. And that just goes into dovetails with, of course, being a contrarian. Being a contrarian means going against the herd. And sometimes that's really hard. Knowing your personal demons, we can end with this. My personal demons, a lot of times, were fear. I was afraid to pull the trigger. And so I have had to work with, over the years, trying to find a better way to pull the trigger. And let's see.
And my demons would be
Go ahead.
greed, just the opposite.
Yeah, just the opposite.
I have a tendency to get greedy. It happened to me, last month. I had a winning month going in the last couple of days, and was trying to add to it. And the next thing I know, my demons took over, and I gave up in the last couple of days, gave up my profits, and I was very ashamed of it. And it's hard to do. And getting back to emotions and patience and focus, I've noticed even Steve and I in our service, it's in this environment, you want to try as best you can to control. It's very tough to do because there's a lot of tension out there, guys. I don't care how good of a trader it is. It's a lot of anxiety, a lot of tension. On Friday, we saw a big green bar in the market right at the open, and we got all excited and let our emotions get the best of us, and I started to buying stocks, and I could feel the anxiety in me, and when I start to feel that, I got to step away and get a grip, and I got myself in the hole. Now later that day in the morning, I got control of my senses, got control of my emotions and focus and relaxation, and next thing you know, I turned $1,000 day into a $1,500. Well, net about $1,000, but it's because I stepped back. I started to being more patient and just focusing, and I felt that last move coming, and it did, and I was able to put a decent day together. But the point I'm making is, even experienced professionals, like ourselves, it's easy to get caught up, in the emotional state of this this crazy market we have going on right now. And
just to finish,
be careful.
Just to finish up on our own personal demons, Andy's demon is greed, and my demon is fear. So here's what happens on a down day or a down week. I have to be very cognizant of my fear and preventing me from taking good trades in the future that I see. So what I have to do is focus on the fact that I've been doing this for 11 years, and I wouldn't be here if I didn't know what I was doing. And when the market presents the opportunities, I have to trust my ability to take advantage and in a relaxed state. On the contrary, since Andy's demon is fear, what will happen to him, thank you, what will happen to him is he might get up on a good month and get really ahead of his goals for the month, and he'll start pressing it up even more, and that'll slap him back down to reality. And that's happened many times in his monthly trading account, where he got a little too big for his britches and he got slapped down. Whereas in my case, I get a little too fearful and I need to be encouraged. So we all have different demons, different areas we need to work on, but the key is identifying those and figuring out how to overcome them and how to work through them. Okay, this is nothing. You're going to learn a lot about yourself trading real money. You don't need to go to a psychiatrist to find out. You're gonna find out real quickly about what your strengths, weaknesses, and fears and strengths are. All right, so that's kind of it for the content, and we've got about 45 minutes or so to do some question and answers. So I'm going to take another quick bathroom break, and I'll let Andy handle the first
Okay.
question. So if you guys have any questions,
Okay,
please.
I'm pulling up my software right now. You want to make me presenter?
Good point. Okay, you should have it there.
Yep.
There you go.
You got it?
Okay, you got a couple of questions coming in. I'll be back in 60 seconds.
Okay, no problem. Give me a little time, guys, here to get my. I'm going to pull up my Ready Plus software. Those of you who go to YouTube are familiar with this layout. Let me just before we go into the question and answers, I will let's see. I'd like to show some of the things we talked about, some of the stuff, and we also have trade ideas. And what I'll do is I'll put do history on here so you can kind of see some stuff that may have been happening at the close on Friday there, just kind of give you a real life idea of what I'm looking at each day here. Okay, we were talking about some of the ETF guys, and I'll get to your questions really quick here, but this is my layout, and I'll show you the second page of my layout also. Let's get all this stuff minimized here. Bear with me. Okay. But some of the ETFs we were looking at, this BGO, this is the one, I'm sorry, BGU, this is the one that I caught on Friday. But if you look at this chart, you know, compared to something like a, let's just find something out there, RIG. Look at all these wicks going back and forth, all the volatility. You can pretty much find even like this Yahoo. This is one I got jigged out of a couple of times on Friday. I mean, look at these wicks and these bars, but look at something like BGU. See how less volatile it is with the wicks. And this is why I'm having a tendency to go more, especially in these volatile times, to go more to the ETFs. This once again, this is that triple bull, big cap, large cap, and this is the one I was in on Friday. But you see the volume bars and coming in. Other ones we mentioned out there, you know, TNA, that's a small cap, had a nice little run, and there's numerous ones. Steve mentioned FAST. Of course, that daily looks ugly. And FAS can be very, very nasty. And that's one you got to be careful with, guys, because it can have some huge moves in it. But the point I'm making is SSO. That's another good one. I mean, look at that, very much like that BGU. I mean, they're just much more tradable. Even though they're double and triples, they're going to move with the market. You're not going to get these crazy ranges. But do you know any others?
Which ones? What's the question?
ETF. I went over like BGU, TNA. I'm not even. Is there a mid cap one? I'm sure there is. Of course, I went over FAS and FAS. What I want to do is kind of show them some of the stuff we've been trading more and more lately. Just finding it, just comparing that BGU chart. Look how nice and fluid that is. You don't get these huge wicks back and forth. It's going to trade with the market. Now, when the market's real volatile and you have these huge wicks, it's going to do it. But I was comparing that to something like even like a Yahoo, these huge moves back and forth.
Exactly. Yeah. Moments of extreme. Yeah. Wicking us out.
This is what I was talking about. Yeah. Yahoo had good volume, nice looking chart, and then we had huge move in the market there at the close. You know, I'm loaded up on 4,000 shares of this, thinking, oh man, money, you know. And it did absolutely nothing but go up there and wick, you know. I'm thinking, great, you know. And that's why I'm going more and more to the ETFs. Okay, I kind of wanted to go over that, Steve, and kind of show them the layout here before I went to the question and answer here. So
okay, sure.
We can dive into that now.
Which one?
Let's see. Let me see. That's where we end off at.
Did you answer any of the questions yet?
No, I haven't. No, I was showing them.
Okay, so the first
some
one
of the
would
things
be-
we talked about that I wanted to get back into it.
First one would be Greg. It's kind of more of a comment, I guess. I have found I would do much better if I did the exact opposite of my instincts. Yep. Yeah, there you go. Again, Greg, it's everybody seems to react the same way. It's human instinct. And just identifying those moments and anything you can do to try and get yourself to do opposite of, like an oh shit bid is one good way that we found to find that moment in time. I will also set alerts. If I find a stock I'm looking at, Andy a lot of times have me set alerts because his software doesn't do it as easily. But I'll have an alert go off, and boy, it's a much better entrance, 30 cents on a pullback just by having some patience and putting an alert out there. Much better than chasing. So if you see yourself chasing and getting into stocks and they're immediately turning around and going against you, you're probably following the herd, and you need to look at a better way to find entries.
Yeah, I think this is probably a good topic to talk about your definition or Einstein's definition of insanity.
Yeah, the definition of insanity is doing the same thing over and over and getting the same results, but expecting different results. So eventually you've got to look at the results you're getting and wonder, why am I continuing to do the same thing, expecting a different result, but I keep getting the same result? So you'll start to notice patterns and habits that you fall into as a trader that are saying, I'm starting to fall into the Einstein's definition of insanity here. I better check myself and see what's going on. Do you guys trade market on close imbalances? Not really. I've never really paid much attention to those, quite honestly. I know some people do, and some people trade, reweighting of indexes. Every now and then you'll get a stock coming out of an index and a stock going in, and I've never been able to make heads or tails of some of those moves. I like to know why I'm in. I like to have a technical reason why I'm in.
Yeah.
Go ahead.
No, I was going to say those things can get really, really nasty and volatile around those times too, man. And I've done it a couple of times in the past, and made some money, lost some money, but for the most part, yeah, I don't get involved in that.
Okay, and Mark has got a long question. There's a tremendous amount of information provided by technicals, some of which indicate opposite divergent movements at the same time. Which of the indicators do you put most weight or refer to most frequently? Is it volume, price, market index trends? For a fast-moving stock, especially if you have more than one or two stocks you're working at the same moment. I know we're always looking at the market first. I think we're always trading the market first, Mark, and then we're trading from the top down. What's the direction of the market? What's the momentary setup the market is giving us? And then moving into what are the strong and weak sectors of the day accordingly. And then from there, are we just going to play the ETF, or are we going to try and play a strong stock within that ETF? As far as putting a priority on the indicators, boy, I say the fast line 10 period SMA is a very important one to me. So is volume. Those are really the two most important ones to me. Again, like I said earlier, the stochastics are probably third in line because they can remain oversold or overbought for many periods, long periods, and it's very hard to just rely on a stochastic. That's more of just a timing mechanism. But I rely mostly on volume and that fast period moving average, the 10 period, because we are momentum traders, and that's why I call that the momentum line. So everything's going to pretty much key off of that movement. Once the stock is making a move, I'm really keying off of that as well as volume. And your thoughts?
No, I agree. I mean, I use my gut feeling a lot. Like for example, on the close of that Friday, I mean, I was long that BGU. Accumulating it down here. We're sitting on a very important level, and at the time the stochastics, nothing was really telling me to be in this stock other than I had a pretty good gut feeling there. And
you know what?
A lot of times I will throw out the indicators and go with my gut, more so.
There's actually a little bit of divergence in there, and you can see it. You can see that little wick popping down to 14, but it did so with less vigor.
Yep.
And another point you want to bring up, Andy, put up the XLF. Remember, at this point in the day, we tried to go lower in the market. The XLF made a higher low. This is just yesterday.
Yep. It was right in there. But it did finally
Okay, I was confused
Yeah.
as to that. Okay.
At the time, yeah. Well, I'll tell you which where it was. If you put up the spiders or BGU, it would be the same. Is on this move right here, on that down move right there, the XLF
Right.
rolled up. I noticed Morgan Stanley and Goldman Sachs were actually going higher during that time.
That's what I was thinking.
And
But we had one more little push down that went nowhere and turned out to be a bit of divergence there. So in this case, I'm looking at that 14 level. Couldn't get through it a second time. Looking at the volume starting to increase here, and those stochastics are showing me oversold. I'll tell you what, guys, it's really hard to take a short position when those stochastics are oversold and expect to get paid. I don't think I touched on that this time. I think we did in the last webinar, but one of the biggest checkoffs I have on a short sale is where are the stochastics. That's where I really use them the most, because I'll tell you, it's so hard to get a stock to fall out of bed that's already oversold.
Yep.
It seems like 80% of the time I take those trades, they don't work, and I start reciting Einstein's definition of insanity. Why am I doing this? Every time I short a stock that's oversold, it proves me wrong. So another good important indicator there I wanted to kick out.
and this is I'd like to point this out because I think it's very important at this time. And Steve made a good recommendation to me the other day, was to put the I've been watching oil a lot lately, but it hasn't been doing a whole lot, so he said, man, you ought to put the XLF up there because it's having such a big impact and influence on the market right now. And so now on my second screen over here, and I'll show you guys before we sign off, I have an XLF chart on there because I know if we get a rally in the financials, this market's going to rally. There's just no doubt in my mind. So what the point I'm trying to make here, I was watching this level here, and this is the same level as the spiders at 6,800. That's if you guys have been watching any of my YouTube videos, that's a key level in the marketplace.
Going back to 97. Going back to 97.
That's a key support level. Now we did break through it. I think, like I said, mentioned to Steve Friday, I said, oh, we want to go take out that 6,500 in the Dow. We want to dip down below that, probably pop up, and that's kind of what we did. But the point I'm making at, I'm in this BGU, and that's several things right here. I'm loaded up on this because we went down that 6,800, bounced, put in a higher low, put in another higher low, so I'm adding to my position here. Got a nice little trade going here. We're trying to get through this moving average. I did scalp some up here above 15. And then, all of a sudden, I see Goldman Sachs going through my explosive down moves. Same time frame right here, boom, going to lows. I immediately just sold everything. Didn't even hesitate because I knew, Goldman Sachs and the financials have been such a drag on the market. And sure enough, if you look at, this VGU, it rolled over. And I got out of everything. But the point I'm trying to make is, guys, keep an eye on the financials. And there's only a few left that really have an impact. Goldman Sachs, Morgan Stanley. I think you got to keep an eye on GE, Wells Fargo, and U.S. Bank. If U.S. Bank and Wells Fargo go the same way as Bank of America did, we could be in for some more, unfortunately, pain for the bulls in the market. But I think you got to keep an eye on those and see if they can hold up.
It's kind of a good segue to the next, the way Andy was just talking about how he was long, Jeff's question here, he was long and immediately saw Goldman Sachs, a bellwether financial, coming through his alerts, going to low, 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 low. You see about 5 or 6, 7 lows in a row, and boy, there's some movement here. Like he said, he didn't even think twice, didn't even ask questions because he knew the market was going to turn around and react to that too. So Jeff's question is, as the day goes along, how do you select your stocks to watch or trade? What gives you the signals to look at particular stocks? Well, the second part of that question was seeing Goldman Sachs go to lows was certainly a signal that the market's going to follow. Let's say just the opposite was occurring. Andy was again long BGU looking for a broad-based rally, and Goldman Sachs starts ripping to highs. Well, probably he's going to immediately double up and start buying some more of what he's currently in. Because that Goldman Sachs is going to be taking the market higher as it runs to highs. So those are the kind of cues we're watching. As you see things coming through your alerts, you're constantly being reminded of what stocks and what sectors are moving to highs and lows throughout the day, and that's one thing that definitely catches our eye. Another is, like we talked about earlier in the morning, paying attention to the ETFs. Which ones are positive from the open, not from the close, but from the open? Which ones are showing strength today? And couple that with the alerts and with what we know to be showing relative strong or weak strength and how it's holding up versus what the market's doing. Those are a couple of really good basic ways we get our ideas. And I'm sure Andy's got some thoughts.
Yeah. Going back to looking at your ETFs, well, we had the BBH, which is the biotech holder, and of course that ran with that DNA move that we had on Friday. The biotech's got a little bump there. Yeah, you always want to keep an eye on what's holding up well and what's not. I'm looking at my board view here. The next in line were the XAL. Let's just pull up one. The airlines have been so beaten up lately, but I was actually in that Delta, and because I saw the way it sold off this morning, put in a big old wick, and I think I bought it right in here. And just because I was watching the airline sector perform up from the close, it had a nice little run. I scalped it out, but the thing just kept going.
That area where you bought it, was a nice little area. You have the low candle ranges, very quiet trading, tight range, and the moving averages, most importantly, supporting the price, giving it a nice little handle, a little support under the moving average there. And I always, that's why I would look at that chart and I would be thinking long, because the moving average is being supported there nicely, the 10 period, right above the 20 period. That's not something I'd be thinking short. And going down to the daily chart, I don't know what's going to happen here going forward, but we just put a nice wick in below 4. And sometimes on these daily charts, those wicks can tend to really pretend short-term reversals. It didn't. It was not the case back at $4 last week, a week ago. But it looks like they're going to try it again here with that hammer. It's called a hammer pattern there on the daily. Nice little green candle body there, closing up for the day with a big long tail showing possible whipsaw reversal. Okay, let's see the next one. Due to the huge daily range in FAS, I think $20 up or down at any given day. What's your strategy trading something like that, comparing it to something that moves only a few cents at a time using way smaller size? I'll let you answer that.
You know what, Leon, that's a very good question, and it's one of the reasons I don't trade FAS a lot. Let's pull up the chart of this thing, and
you almost have to give it $2 wiggles.
Yeah, you just have to give it to some really huge ranges.
Let's look at that average candle.
What I typically will do in a stock like this is, I'll get too much size, even if it's only a couple hundred shares, but there's just a lot of noise, Steve calls it, and you get a lot of wicks back and forth. These are stocks I think you almost have to just bid in, use the bid and offer a lot, and take advantage of the momentum. If you're in this thing on the long on the close right there, you just basically lost 15 points. So they could be very dangerous. I tend to stay in this environment. I tend to stay away from them just because they're scary, and I know how oversold we are. And, I have traded them. Don't get me wrong. I've traded that. I've traded SDS. Made some money on SDS quite a bit. It's another one that can be extremely volatile, not as volatile as FAS, but I've traded that one frequently. I've made some money on that one, but
I think anytime you're playing a stock like that, you've got to recognize the range in those candles. If you go back to FAS, you'll see a lot of those candles are $3 and $4 ranges, and it just makes you realize you have to be able to withstand $2 and $3 moves if you're wrong, because if you just go in there and give it 50 cents, you're probably right, but you're just going to get wicked out because of the volatility inherent in that vehicle. So. Another thing to do, is if ever there was a stock, to try and be contrarian with, that's going to be one of them. Trying to buy those things and chase them after they've already run $3 is really hard. You have to give them so much wiggle room. There's so much play and so much slop in there that all you can really do is just go down to the smallest of share size and really focus on your entries. And that's a classic stock that, it's been a good momentum stock, but It moves quickly, so it's one of those ones where, once you got a pretty good trade in it, you want to be selling when they're buying and buying when they're selling, because when those things turn on a dime, it's really hard to get out. You can lose a dollar just trying to get out by, waiting 10 seconds to figure out what you want to do. So being a good contrarian trader, those are some of the good ones to trade. Let's see, what features are good features to look for on a trading platform? Alerts right off the bat. I always realize that my trading platform, which I'm using as Lightspeed still, has a real nice alert feature. I can just hit Control A on the stock I'm looking at and put in a price and hit enter. And the next time that stock trades at that price, I get a pop-up window. And sometimes it's 10 minutes later, sometimes it's 2 hours later. But I really like that feature, because whatever you can do to alert yourself in those brief moments of opportunity, you only have a small window of opportunity sometimes to get a good entry. And if you don't have an oh-shit bid or an oh-shit offer out there, the alerts are the next best thing I think that a software program can tell you, to pop up and say, hey, you told me to tell you when this stock approached this level. You liked it earlier. What do you think now? You pull it up now. You look at the S&Ps. Is the market still behaving in the way you want it to? Is this really a good entry? Yeah, let's take it. So having an alert feature, I think, is very important for a good trading platform. What else? I think execution.
Yes, reliability is probably the key factor.
Yeah,
You want something that's reliable, and especially when you get volume coming in, it's not going to freeze up on you. That's what I do like about the Ready system. It's very reliable. I haven't had any issues with it. Maybe just a couple, but nothing major.
Also, the Ready is it definitely is not one of the easiest platforms to trade on. Both Andy and I have been using the keyboard to make trades using the function keys, F12, F11, F1, F2, things like that. So to have to go from keyboard over to point and click, because Ready, really, it's just a great stable platform, but it doesn't have a lot of the bells and whistles that active traders would like setting the alerts or fast action keyboard functionality for entering trades. So but reliability is a big one, of course. Anytime you can get a feedback, if you're ever thinking about shopping a platform, if you can find anybody that's using it, Robert, and ask them, a couple questions. How is it when the volume really turns up high? Are the quotes still reliable? What do you like about it? What do you not like about it? But in my opinion, setting alerts is really important to me. And if it doesn't have a good chart package, you'll have to go out and get your own chart package. Again, Ready does not have a good chart package, so Andy is having to use eSignal to link up to Ready for his charting. But he's going for reliability there over function. Where on Lightspeed, I'm not doing as much trading, and I've got mostly bells and whistles on mine to kind of help him along. Next question from Greg: any idea why Lightspeed does not offer trailing stops? I guess it's just not built into their framework. What they do offer is the trailing stop, but you have to continually adjust it. And I know what your question is, Greg, is why can't I just say put in an order, excuse me, that's always trailing 10 cents behind. So if the stock moves up 20 cents, my trailing stop will move up. The bummer is, you've got to manually cancel and replace those trailing stops. It doesn't offer that like TradeStation and some of these other programs, and it's probably just the way it was, the architecture of the software just doesn't allow for it. Next question from Robert is more for Andy, because he does play the pre-market and post-markets, and he's got kind of a strategy and some thoughts on that, so I'll let him explain. Are you on mute, Andy? Oh, you probably went off mute again. There you are. Well, while he's getting his sound back up, there are certain days where there's a lot of news, and the more volume you can have in the pre-market, the better. So the way it's been lately, he has been trading a lot of Bank of America in the morning sometimes when there was some pretty good volume. And what you want to do is avoid trading pre-market and post-market just to do it. Are you back?
Yeah, can you hear me?
Yeah, I can hear you now.
Okay. I'm sorry, for some reason when I put my hard mute on, I just won't use that when I use the soft mute from now on. But
there you go.
Yeah, it's not coming back when I put it back on. What question is that, Steve?
Why and when are you playing pre-market, and any thoughts on pre and post-market trading?
You know what? Until recently, I don't trade pre and post market. I've done it in the past, but I went on a sabbatical for a long time. But lately, there's been so much action in news, especially from like government officials and agencies and things like that. That I'm seeing some action in in both pre and post market. So lately I've been doing a lot of trading. And actually been doing well in pre and post market. A lot of the financials have been having some moves, but
The key is the volume and liquidity has been there.
yeah. You want to definitely look for volume, and for the most part, you're just kind of trading off level 2 because I can fix my charts to do pre and post market, but it's really kind of a mess anyway when you get that kind of action. So. I don't recommend it, and I don't know how long it's going to last. I probably won't be doing it much longer because I know it's already starting to slow down. But for a while there, some of the banks, BAC was having some nice moves in the city and after hours, and I've been making some money. Actually, make some money on after the close on Friday. An extra $200 just there was some stuff moving. The banks, the financials were moving in after hours higher. I don't know why, but they were, and I was able to capitalize on it. But like I said, I can see it slowing down, and I don't know how long it's going to last, and I really prefer not to do it because it's tough when you get in here and sit down from 12 hours in trading. But there's a time, and I'll always find something that's thick. You got to be careful because it can be really thin. I don't like really trade earning calls and after hours because that can be a mess because you have conference calls, you have people that are privy to the news that you're not at the time, and so I don't really trade earnings. But if I find something that's relatively thick, say thick, you got a nice, size bids and offer, and the stock's moving and trending nicely, yeah, I've been trading lately.
All right, and also, those alerts that we showed a lot earlier in the presentation, the pre-market, post-market on trade ideas. Even if you're not trading the pre-market, it's still a good idea, like we said, to kind of get an idea of what is active pre-market. What's the market talking about? What are the pre-market active stocks? If you can figure that out, then you can watch them during the market. You don't have to trade them pre-market, but at least find out who they are and keep an eye on them as the market opens up and starts to trade. Like on Friday, it was Wells Fargo. It was very active pre-market based on some comments the company was making. And so going into the bell, that was kind of our focus stock of the day that we were watching.
And now that I look at it, guys, I'm pissed off because I was in about 3,000 shares of Wells Fargo, and you see it went out at 867. Well, I sit here for about an extra 2 hours. Finally, about 4 o'clock, I said, I just took my profits in it at around 880 or something like that, and now I'm looking over here and you see the last prints. Look at these last prints that went out on Friday afternoon. Trade all the way up to 9. USP. Went out at around 870. Look at these last prints. That's huge. It's huge moves in after hours. And now in hindsight, I'm starting to see that I left some money on the table.
There is a play too that used to happen a lot in the raging bull market. And if you could catch a day where the market exploded and closed on highs, it was almost a given that you could stick around and sell your stuff post market or even hold it to open up, gap up the next day. I wouldn't trust that in these market environments, but there are going to be some days where it's just a whopper of a rally. I'll say rally because at these levels it's probably what's going to happen at some point. Oversold rally. There's going to be a day where that's it, and we have a nice big up day, and we close on the highs. We did pretty much nothing but move upwards, move sideways midday, and finish the day on the highs. Those are the kind of days where if you got some good positions and you've been holding them into the bell, you don't necessarily have to get out of the bell. There could be some continued demand after market as people realize, oh boy, this market's going to gap up tomorrow, and I either need to get out now, cover my short now, or get long now, and so there is a situation there where you can have some spillover into after hours. By no means does that happen every day. It's occasionally when you just catch a major reversal in the market and you get some action after the bell. Next question.
I just want to throw out Bank of America was another one. I had 5,000 shares at 17 here, and finally got tired of it. Around sold it for basically a flat, and I'm seeing now things like another 12 cents an after hour. So that's kind of in the last hour there. So be interesting to see if
That was that was a Friday, and these are probably people that said, "Oh boy, I sat through that close, but I don't know if I want to sit through the whole weekend. I better just cover this. I better just cover this stuff now before the weekend." And it's a moment in time when you catch a good contingency of traders off guard, and you got them on their heels, and you're on the right side of the ball. That's the time of day to maybe bleed into the trade, close and after hours, and see if you can catch. Because if you can get volatility on your side, if you throw some good offers out there, you might get 10 cents higher than you would have at the close. Yeah. But you got to know when the right time to do that is, and it's certainly not.
You really do. It can be very dangerous, and like I said, you can put up what I usually do is put up my pre-market, and then I put up my post-market movers down here in my box here, so I'm watching them come across. And I also have my ticker over here that constantly runs in pre and post-market, and that's where I saw the USB, the WFC hitting 5 and 10 minute highs and after hours. So, but you have to look, make sure the prints are going off, make sure there's volume there, and like I said, play something thick, guys. If you do it, I mean, like I said, I don't recommend it only for experienced traders, but lately there has been some opportunity.
Here's one more play you can do. Like let's say Apple, big contingency in the tech market in the Qs. Let's say Apple comes out and upside guidance after market. All of a sudden, Apple just rips 5 points. You can't even catch it. But what you could do is you could grab some Qs. There's enough liquidity in the QQQ after, and I've seen it many times. If a big tech stock or a big bellwether stock either warns and has a horrible puke after market, or comes out and upside guides, anything after market that is a significant change to a bellwether stock. And the reason I use the Qs is because, that's kind of the best play that I can think of. If Apple or RIM or Google were to come out after hours and just explode on incredible news, there's a sympathy play where you could probably feel comfortable grabbing the Qs after market. There's enough liquidity in those. There's enough liquidity in those. I wouldn't grab the spiders because that's more financial, more broad market, but the Qs are more tech market. So you could, and I've done it before where I've just played the proxy aftermarket because I know there's liquidity in the QQQs, and they're probably going to move in sympathy to a big name tech company that's either warning or upside guidance. Okay, next, Steve and Andy, which chart software do you guys use? Which is Ready Plus? And last, which broker would you recommend? Thank you. Well, again, I'm using Lightspeed, and Lightspeed has a chart component, which isn't great, but it's functional enough to where I'm just going to continue to use that so I don't slow down the system. Ready, that Andy's using, does not have a chart functionality, so he's forced to use the eSignal. From what I know, one of the best charting packages out there, it's a bit pricey though, is Townsend Analytics. It's called Realtick, yeah. Realtick from Townsend Analytics. That's a great one if you can get your hands on that, but it's a few $100 a month. And yeah, these things start to add up, software fees and charting fees and SEC fees and whatnot. So, yeah, that's a pretty good system Andy's got there. eSignal's pretty good bang for your buck. This is a good question from Mark. I like this one. I've heard you mention that you check out Fast Money and other CNBC programs. In your experience, is there any real substantive value in their information, or are they largely for entertainment value? Do you find it too easy to be overly influenced by this kind of media static? I'm not overly influenced, and the only show I really watch is Fast Money. I can't watch Kramer. That's entertainment value for you. But the reason I like Fast Money is I'm not so much just following their picks. I like to know what are they talking about. These guys are all coming from major backgrounds of trading, and they're given good information about what their trading desks and their network of friends are talking about. Now, whether or not I'm going to follow their pick is not the reason I'm watching that show. I just want to know what's in the news, what's in the buzz, what's the chatter, why are the traders talking about this particular sector. I'll bring it up and I'll make my own decisions on it. But I do want to know what's being talked about out there, because sometimes you can get a heads up as to where the money's moving. By no means are those guys experienced unbelievable great traders and have killed it the last 6 months, because they haven't. They've been sticking their neck out online, trying to find some silver linings in the cloud, but there's just not much to be had out there in this unprecedented bear market. So, I know Jon Stewart beat up on CNBC the other day, and it was kind of a funny bit, but they're doing the best they can. But I'm not taking everything they say at face value and turning around and trading it. I'm just looking at what they're talking about and trying to run it through my own filters and see, what I think about it. Any thoughts on that?
No, I agree. I think you got to remember that these guys are active traders, especially the Najarian brothers. They're pretty much, as Mackey called them, geeked up Armenian day traders. So, yeah, they're in the action. They're in the pits and in the action. Unlike a lot of these talking heads that you do get on CNBC. So yeah, I like to hear what they have to say, and for the most part, you have to take it with a grain of salt. You have to make your own judgment and opinions, but they'll talk about some options that are happening out there. There's a lot of call buying, a lot of put buying, and it's interesting stuff.
You can also fade, meaning go the other way of CNBC, and a lot of times. Andy used to do this all the time after hours. About 3 years ago, he'd be watching Cramer, and people would call in and say booyah and get all excited about a stock, and they'd pump the stock up, and Andy would actually fade it and take the other side of it. Once the people got all excited and came in and bought, maybe 5 or 10 minutes later, he'd start selling it, and that was kind of an interesting little way to use CNBC as a contrarian device. And here's another thing. Recently, Jon Najarian and his brother Pete, the option guys, they've been kind of tipping their hand a little bit, letting people know on Twitter, which I've been following his account, saying, hey, I'm in the green room at CNBC. I'm going to be talking about the XLE, Energy Spider. And that's almost kind of a gift. I don't know how long it's going to last, but I've watched a couple of those the last few days, and what happens is you start to get people quietly buying in the XLE, and wouldn't you know it, as soon as Jon Najarian comes on and starts saying how much he likes the XLE, you got a lot of experienced traders who are already long that thing because they knew he was going to talk about it, and they're just sitting there selling it to the people who are sitting at home waiting for CNBC to tell them what to buy next. And so there's another contrarian play you can do. And, I'll tell you what, guys, do it for yourself if you want. You can subscribe to Twitter and start following Option Monster. And he kind of tells you when he's getting ready to go on TV. And there's been a couple of interesting plays there where if you don't want to go long, you can do it, but you can fade it. You can let the people come in and buy it and push the stock up for no good other reason other than the guy on CNBC said he likes it. Then you can turn around and start shorting it. And eventually it'll settle back down. So pay attention to little anomalies and little things that happen like this and try and find an edge, try and find an inefficiency where you can be that person going against the herd, because the people that are listening to him and buying it at face value are on the exact opposite of what you should be doing on that type of a trade.
Yeah. And I'll tell you what, there's Karen Feinerman, man, she's smart. And, man, you hear the size of the trade she's on and what she's doing, and she gives the reason why she's doing it. And I'm watching a lot of her trades, man, work out. So
yeah, people come in and say, hey.
They can give you good day trading ideas.
Somebody will come in and say, hey, this company just said that. What do you think? And she'll say, no, that hasn't changed my opinion at all about this company. Exactly. And she's right. It's just a short, euphoric burst of an upside, and she's pretty good at knowing where the book value and where the problems lay on these companies' balance sheets. And so that's another indication of how you can take these people for, face value and run it through your own filters and see how you feel about it. Let's see here. A couple more questions. I see Eric stepped away. We'll do that last, Eric. We'll show Andy's second screen and show a couple of things that we do look at, because we're always looking at the market. And you're right. There's one screen that you can't see. And on the right side of our desktops here, I have the spiders and I also have the Qs. Andy has the spiders, and he's now using the XLF, as we talked about, because the front.
You know what? Let's go ahead and bring it up now.
Yeah, why not?
There it is. And, basically what I have here is my my sector watch list. We pulled and we showed you that in the webinar there. A couple of more alerts. This is just the sector movement showing if you're seeing the sector running up or running down. Do a history on this real quick.
Yeah, those are going to be a lot. Those are going to be a lot more active. There you go.
Yeah. I just kind of like to, keep an eye, see if any of them's doing anything, making a move, seeing relative volume coming in. And what this changes, I did for the longest time. I've had the USO last year. we were trading airlines. I made a lot of money trading the airlines last year off oil. Now that trade has somewhat become detached and not really working for me. I do like to keep it something oil up just because it's a good indicator of how the economy's going, you know, and there's demand for oil and other minerals, and it could be a positive for the economy.
Yeah.
If you look at oil on ran up and closed on highs, okay, in the pits, basically meaning the future contracts, that gave me a pretty good indication that we could possibly see a rally on the close there, maybe some short covering, because oil held on to its gap up as the market sold off and closed on highs. So, and sure enough, it came to fruition. If you see the spires down here, finally did get that rally.
You know, that oil is a good indication of how the markets are constantly changing, how what worked a year ago doesn't work today. A year ago, we had oil at 150, and every time oil spiked up, the market got scared because it wasn't focused on the financials so much as it was focused on oil at the time being a very expensive commodity to drive our economy. So every time oil spiked up, the market got weak. Well, now it's the exact opposite. Oil's down here. It's a much, much lower level to where the economy is not spooked about it. And if anything, it's the exact opposite. Anytime oil starts to ratchet up, the stock market's wondering, hey, are the oil guys seeing some sort of recovery? Is there some sort of demand coming back into the world here? So it's the exact opposite of what worked a year ago is not working now. So you've got to constantly keep an eye on how things are correlated and paired up. Going back to the board view there quickly on the left, again, we're watching that mostly in the first 15, 20 minutes of the day. Mm-hmm. By midday, we pretty much got a good idea of, you know, what's strong and what's not, unless something news-related comes out. But that board view is being looked at mostly in the first 20 minutes of the day. And that's it. You know, we're constantly watching that 5-minute chart in the spiders for market direction. That's really what we're trading off of, is that bottom screen right there. And
this one's just another little high ticker. This is only stocks, so you know, hitting highs kind of gives me an idea of what stocks are strong. Occasionally we'll look to maybe buy some pullbacks or something like that. Yeah.
A couple more questions, and then we're going to wrap it up. We do have a few in here. So you guys feel that you're better off trading as a team? Do you think that you would have come as far as you had you not been trading alone? No, you know what? You're right. That's a good point. And we are probably a good team because we kind of, like, my greed and fear demons are the opposite of his greed and fear demons, so we do kind of keep each other in check. And it's always nice to have somebody to talk to. I've traded alone. When we first learned, we were on a room with 20 other guys. Some people were cheering and laughing. Some guys were cussing and throwing chairs through the wall. But at least you had that dynamic of people around you kind of giving you extra sensory feedback as to what's going on. You could kind of just feel the murmur. When you're trading alone, you don't really have a whole lot to go off of except what you're seeing. So, you know, the more the better, and the people you're trading with, it's like hunting in a pack, hunting in a herd. More eyeballs, the better, and especially if you guys are on the same page. Andy and I literally learned to trade a month apart in the same room, so we've kind of evolved very similar. If I grab somebody else who's been trading for 10 years, they might have a completely different approach and mentality, and that's why I look at trading as an art form. It's a subjective art form, not a science. What works for some people doesn't always work for others. So, but that being said, yeah, I think it's much better to have at least another partner to trade with if you can, especially somebody who's on the same page as you. And like Nathaniel says, it seems like we keep each other in check. We try to.
Yeah. Now, Steve has to get on me a lot of times. Help me out to get a little carried away with my greed sometimes.
I got to remind him sometimes.
That's the great thing about our service. You know, we've had a lot of positive feedback. You know, just people, you know, that are in remote places and that don't have a place to go to, but they can come on here and they can use the chat log and talk to us and answer. You know, we can ask questions. They can see what we're doing. So there's a lot of cross communication.
They'll say, "What do you think about this chart?" And we'll say yes or no, or why we like it or why we don't like it. So yeah, the more feedback throughout, the better. Hunting in a pack is much better than hunting solo, I think. Speaking of Twitter, Brad Clark asks, which one of you is doing the post during the day? That's me. My trading has backed off a lot. I'm leaving the heavy lifting to Andy, and we're just using his as the benchmark trading account, and I'm doing a lot of stuff behind the scenes, and Twitter is one of them. I'm really enjoying using that as a real-time vehicle to kind of get out what we're thinking about at the moment for people who might not be able to trade the markets but are sitting at work and they maybe, thinking about making a trade in their account, and they're just, it's a way to keep in touch. for people who aren't able to watch during the day, and I like it. So it's me doing all that stuff. I'm answering emails and doing Twitter and scanning the market and trying to do a lot of the co-pilot stuff, I guess you'd call it, and letting Andy fly the plane. How many screens do you use? We actually both use 3, and I'm just using my laptop as a 3rd screen. I'll use that for, which is now the Twitter, and also for my briefing.com and news. So, the more real estate you can have, the better. There's no way in the world I could trade off of just one screen. I need at least 2, and that 3rd screen is kind of more for me to do some of the other stuff that I'm doing, like on Twitter and emails and other stuff. And I know you use a 3rd screen too. You put your briefing on there. I think you've reset your volume here, your audio again, Andy. There you are.
You hear me?
Yep.
Okay.
Well,
I don't know why it's gotten crazy on me today, but yeah, I do use a laptop for my my briefing.com and my IM. But
yeah, IM. We have instant messenger.
So, yeah.
We're also there's probably 5 or 6 other traders we're in touch with during the day, bouncing ideas off of that. So if you're not in the same room with somebody listening, IM is a great is the next best thing. AOL Instant Messenger. And we've got a few traders on there that we bounce ideas off back and forth that we trust. So, yeah, communication is good in this environment.
Well, I want to say one last thing.
Okay.
I was in some SSO the other day and after hours, and guys, stay away from the doubles and triples. They're kind of funny, I don't know if they re-evaluate these things at the end of each day or what, but I would stay away from the doubles and triples and things like that in after hours because. Luckily, the trade ended up okay, but they don't. It's kind of weird. I couldn't figure it out. It wasn't trading with the spiders in the same. What's the word I'm looking? Same percentage wise as you think they would. So those are tricky. So definitely, I would leave those doubles and triples along in after hours.
But if you're having trouble making sense of trying to find the leadership stock, or the leadership stock is not performing the way you think it would relative to its peers or relative to its sector, take one piece of the equation out and just go to the ETF. Not all sectors have a tradable ETF, but a lot of them do. Home builders, steel, whatever you want to play. There's usually an ETF that may be able to accomplish that for you. And then there's one more thing. I'll just let you go on this last one, Jeff. Yeah, as far as Twitter goes, the actual Twitter page is a static site. It doesn't update. So I recommend downloading a thing called TweetDeck. Tweet DECK deck, and that is a real-time Adobe Air, I think is the platform it runs off of, and it gives you a nice, easy, dynamic way to see the trades come through. But you're right, other than having to hit refresh, that's no good. So after the first couple days, I figured out that this TweetDeck thing is a lot better, and so I run that on my laptop in conjunction with my news. And also, I forgot to mention, I run the GoToWebinar as well, so I got to have a laptop to run that as well. So I got a lot of stuff I got to look at more than the average trader. So that 3rd screen really does help. So TweetDeck is where you want to go for that, Jeff. And trying to. There's a lot of people on Twitter that just blabber out spam and look at me and this, and I'm trying to put each Twitter tweet that we put out there, some sort of nugget of information, something to be learned from it. Sometimes I'll even do a snapshot of a chart and draw the chart up a little bit and attach a picture to it. So trying to make those as educational as possible, not just blurting out stocks left and right for no reason. All right, guys. Well, that was fun. Again, 3 hours went by pretty fast. And so what we'll do is I'll zip this all up and give you guys a link to all your emails. I'll send out a email blast later today, which will have the information on how to download and keep this for posterity and rewatch it. And what else?
That's it, man.
That's it. I'm ready for the weekend.
Yeah, thank you for your
support,
your questions. Yeah, and covered a lot of topics today, and I thought it was very thorough. So thanks again, guys. Thank you for supporting us. And
I think we may do one of these in the future, maybe another 5 weeks away, but it's going to focus on swing trading. It's going to focus on short-term trading, not intraday scalping and maniac firing off trades left and right, but it's going to focus more on people who are maybe looking to grab a little bit of control over their retirement accounts and try and be more active in taking some trades in their long-term accounts. Andy has also done a pretty good job in his long-term account, outperforming the terrible returns we had last year. So there is a way, to do it. We've got some thoughts on how to help people who want to take an active role in managing some of their longer-term trades, and that'll probably be the next webinar in the future. So keep an eye out for that. All right. Well, thanks everybody.
All right, guys.
And we'll sign off
again.
here. And I'll send an email out to you guys later this afternoon with some information on how to archive this stuff. So appreciate it. It was fun, and we'll see you Monday. And that's it. Have a good day.
Thanks again, guys.
Have a good weekend.
Have a good weekend.